Welcome to the second day of our special coverage from the 29th Annual Milken Institute Global Conference here in Beverly Hills, California.
Your name is Romaine Bostic.
It still is, Katie Greifeld.
I am Katie Greifeld. We have some big names joining us over the next 3 hours. They include Katie Koch of TCW, Manny Roman of PIMCO, as well as Rick Rieder of BlackRock. And that's really just a taste. We are packed with quality today.
Absolutely. And so let's get right into it. We're actually going to kick off the show today with Wall Street Royalty, the firm that Alan Schwartz built from scratch, flexing on two fronts. Its securities unit, it's been adding senior bankers across aerospace, software, consumer, expanding into Europe, all while a lot of his rivals are pulling back. The asset management division, they just closed one of the largest private credit raises of the cycle, and he's been building out his energy bench as the AI boom drives up demand for electricity. Alan Schwartz joins us now, the executive chairman of Guggenheim Partners. Great to see you, Alan.
Nice to see you, too.
I mean, you guys are no stranger to energy. You basically pioneered the 144A securitization. You have the Renua deal. You have to explain that to me with regards to the land lease financing here. But when you walk around this conference, it doesn't matter what business you're in. Everybody's talking about energy infrastructure in some way or another.
Yes. Well, look, we've had a few decades of relatively flat, demand for electricity, and all of a sudden we're electrifying the entire economy plus AI, and so the demand curve is moving like this, and we are far behind in the war to make sure that we have the electric power to allow us to compete, especially in AI, because if we don't have the power to compete in AI, as somebody said, it would be terrible to win the technology race and lose the power race for AI.
Wow. Is the capital there to do this?
The capital is there. Fortunately, if you go in the past when you had a new technology, for example, wind and solar, the government would create a credit. The credit would allow it to be deployed at a high price, but allow that price to come down through the development and the learning curve of pricing. The government can't do that now for some of the new power sources, but the large, data center users and, the hyperscalers have the capacity they can today pay the very high price that electricity will be, created at, and that will allow it to come down. So that's a very important point that we're getting pushback that the public's afraid that data centers are going to come and take away their power or drive up the cost of power. And the reality is we need them to be the ones leaning in to bring down the power curve for everybody else and the cost.
Well, that's exactly what I was wondering about. You think about the narrative that has emerged in the population about data centers, and there's a lot of not in my backyardism. And certainly, if you take a look at the map of where data centers are distributed, they're really concentrated in a few places in the country. And I wonder, obviously you see this as an opportunity for Guggenheim, but do you worry that, there could be some regulatory risk here, some political risk here at some point?
There is. The NIMBY movement is a concern, and it's actually backwards, is the point I'm trying to make. I mean, you look at Georgia, for example, which is the largest user, they're using the deployment of power to the data centers to bring down the cost to the average consumer. As I said, the government used to support it. Now they can pay the high price to get it created and come down the learning curve and make it available to the population. So it's the exact opposite of what people are concerned about. I mean, it has to be regulated properly for that to happen, but it's the exact opposite of what people are afraid about, and I think the message has to get out there.
Yeah, it's interesting. In some ways, it feels like it's parallel to the conversation that we have around institutional ownership in housing. Whether or not the facts back it up, there is that perception out there that that's driving up costs, and maybe that applies to energy as well. I do want to throw you a little bit of a curveball because we heard from BlackRock's Larry Fink earlier today on a panel saying that you think about the U.S. right now, we're short power, to your point, we're short compute, and we're short chips. And as a result, he believes that we're going to see an entirely new asset class in the form of basically buying futures of compute. And I wonder, when you think about...
Futures of what? I'm sorry.
Of compute.
Okay.
And, maybe you don't agree with that specifically, but do you think that, the forces that we're talking about are profound enough to be creating new asset classes here?
Yes, I think, whether or not we're going to have a specific futures market for compute or whatever it is, there is going to be a significant opportunity for a flow of capital into the things we need the most. You know, we've gone through this period of, you know, believing that we can get whatever we need from wherever in the country it's cheapest and it will always show up on time and everything else. And now as we move into a multipolar world, there's an awakening that we have to be careful not to be dependent on one country to get everything we need to build our future. And so that reshoring opportunity is one where there's going to be a lot of opportunity for investment.
Speaking of opportunity for investment, obviously over the last few months, there was a lot of hand-wringing about the state of private credit. You guys just had a huge new debt fund, $8.4 billion or so, at a time where everybody's looking at this space and thinking, why would you be pouring money into it? The fact that you're able to raise that, the fact that that actually hits your hard cap, if I'm correct, seems to show that there's still a lot of demand out there for that. Why?
I think there's two things. Yeah. First of all, there's been a lot of demand. That is beginning to fade. Secondly, in our side on Guggenheim Investments, we did not raise a ton of private credit in the last, say, 6, 7, 8 years because we thought that the market was a little too ebullient. Mm-hmm. And so we've been going to other sectors where we can find opportunities. Now is the time to raise private credit capital to take advantage of what there might be opportunities if the private credit market cracks. And we are concerned that it will.
You are concerned?
Yes.
But to a point where it could be systemic? I mean, we should point out, I mean, you were, before Guggenheim, you were the last CEO at Bear Stearns. So, I mean, you had a front row seat to what was going on during that crisis.
Yes.
I mean, when people start talking about parallels between 06, 07, 08, 09 and today, is that fair?
It's fair. I don't think it's going to turn out to be anywhere near as significant. Mm-hmm. So it's fair in this sense. One, that whenever you have a sector that grows very rapidly that in the past has not grown so much, you have to worry about that. Is it going to have excesses? We've seen that in private credit. We had a tremendous increase in private credit after the financial crisis, which I read about, and a lower quality rating in that private credit market. So we've been paying a lot of attention to that, which is, I say, why we didn't raise as much, but also on the security side, paying a lot of attention. The recent, demands for getting their capital back has put some focus on it, and there are some tremors in that market. Now, systemically, I think it's different in this sense. One, I do think that a lot of the big players in private credit, the Apollos, KKR, are very sophisticated investors. So I'm a little less concerned that there's going to be a rapid, or a big, huge amount of problem. Second, the last time in the financial crisis, it was the banking system that got paralyzed with all of these assets. The banking system is let's say, the arteries for the monetary authorities to put liquidity back in the system. So if the arteries are clogged, it becomes much more systemic. Now the banks who cut back on a lot of this are in very good shape. And so this private credit, I think, can be handled in a better way than the financial crisis was able to be handled.
Well, it's interesting. I mean, you mentioned the Apollos and the Ares of the world, and you're not really concerned about them as managers. But it was interesting. We heard recently from the head of spread products over at Citi warning basically about tourists in the private credit space, that you've had a lot of managers who spotted an opportunity there and came in a big way, and then maybe that's who you see come out. And I wonder if you would list that as a concern of yours as well.
Yeah, I think so. And I'm not saying there won't be fractures in even the very good managers. They're going to have some issues. I just don't think they'll be tremendous. The issue is we're seeing anytime you have an asset class that is illiquid and non-transparent, and now when you're getting redemption calls and you may get margin calls, the lack of any knowledge of what the market is or what that particular credit is, because it's not transparent, makes it a very difficult asset category to get fixed, because there's no marketplace to go to. So it can spasm and create some significant problems. Mm-hmm. I just come back to we're seeing an increase in shadow defaults and things like that. So it's something we have to keep an eye on, and I'm not saying it's going to be really small, but I don't think it'll be systemic.
Well, Alan, I do want to switch gears a little bit, because we brought up 2008, and someone you saw in action in 2008 was Kevin Warsh. And
sure did.
Kevin Warsh, if all things go smoothly, should be the next Fed chair come this month. And, you think about the central bank makeup that he's inheriting here. 4 dissents at the most recent Fed meeting. You think about what a Fed chair has to do. It's not just policy, it's also politics as well. So, in your experience knowing him, how do you feel in terms of how he's going to be able to orchestrate all these differing opinions on the Fed right now?
Look, I have said this before. I don't think there's a better person to step into that role today than Kevin Warsh. He was the superstar, in my opinion, interacting with the government in the financial crisis. He's very analytical. He's a very analytical person. So people who think, I'm going to come in with my desire and my demand are wrong, he's going to create analysis. Now, separating the near term, if he came in tomorrow, let's say, given what's going on in the energy markets, Iran, et cetera, he's very, very good at using the team to analyze what's happening in the markets. The near-term policies are going to be based on the data that they see out of that. But then longer term, I think that what he sees is something that I totally agree with, is that I think we've had a bigger productivity revolution than a lot of us realized was happening. And Kevin was seeing that. And that has impact on the way markets react to interest rates and the size of the Fed's balance sheet, et cetera. So I think he's got a vision of where we should be going long term, but he's not going to dictate it. He's going to bring the credibility of research to the team and the board to look at.
But when you say vision, if you take him at his word, this is potentially going to be a real philosophical change in the way that the Fed is led. Are markets prepared for that? Do they understand it?
I think that his point will be the markets will turn out to react differently than the models would say. Look what we've seen so far. What did we think was going to happen with the increase in tariffs, with the shortage of different things, as we've talked about? But somehow corporate profits just keep going. Inflation hasn't taken off. The economy is going to, against all of these things that we think would flow through. So you have to rethink the models, and then you have to articulate it to the public.
We are getting a bit of a rethink in the philosophy behind monetary policy. Do you have any hope that we'll get a meaningful and, more importantly, a constructive rethink of fiscal policy?
I think that's very, very important. I think the challenge there is, as you say, the politics of getting a group of people in a room who are all there for the same reasons to come together on a change in policy is a little bit different than trying to get the Senate and the administration and Congress together. And we have a real issue with that. One thing about it, it could become more important because I don't think people realize that post the financial crisis was the first recovery in U.S. financial history that we had an actual decline in consumer credit as a percentage of GDP. Every other recovery, there was more credit, more credit. So the government stepping in and borrowing more was actually in some ways a necessary thing. But it also created an environment where people would say, as much as the government borrows doesn't matter. And on top of that, we had interest rate compression where they were able to refinance their high coupon debt with lower coupon debt. And so we went, let's say 15, 16 years where interest expense was flat while debt doubled or tripled. So there's a complacency in the market that now consumers aren't going to keep delevering and interest rates are no longer able to refinance at lower rates, so that the pressure that could come from the market that would force some reconciliation could come. But I think without it, it's going to be very hard politically to find something that you can get a consensus around what to do.
Absolutely. Well, Alan, really great to have so much time with you this morning. That is Alan Schwartz. He is executive chairman over at Guggenheim Partners. Really fantastic way to kick off this program because we touched on a lot when it comes to, the energy needs of this country, especially as AI becomes more ubiquitous, and a little bit of Fed policy there as well.
A little bit of Fed policy. It's a little bit of everything. And we've talked about kind of this sort of mashup of what we see Wall Street, Main Street, and now Washington, particularly with Washington now, really in the mix of it all.
Well, we also talked about private credit. And coming up, we're going to hear from one of the largest investment management firms in the country about what's ahead for both private and for public markets. TCW President and CEO Katie Koch. She joins us next. This is Bloomberg. Katie Koch has sat at the helm of TCW, one of the country's largest investment management organizations, since 2023, and that was after a 20-year run at Goldman Sachs Asset Management. She's now navigating TCW's $200 billion plus in AUM through a changing market landscape, expanding into ETFs and private credit. I'm pleased to say she's sitting right to our right. Katie, it's great to see you.
It's so great to be here. Welcome to my hometown of Los Angeles.
It's a little chilly.
I know. This is actually bad weather for LA. So it is an amazing place to live, and we are so proud to have this conference here.
Well, I'm very excited to talk to you. This is my first Milken, but I was looking at some of the comments you made at last year's Milken, and what a moment, because you said that when it comes to direct lending, when it comes to private credit, that we are now going to start to see some of the accidents in this asset class. And sitting here a year later, it certainly feels like we've started to see that. But did it play out the way that you were thinking this time a year ago?
Yes, so we did say that we thought there would be accidents ahead last year. We have seen some of those. And now our outlook is we see tremendous opportunity, because as is usually the case, when other people are heading for the exits, that's why you want to get involved. And Katie, if I could, I'd love to give you a little bit of context on how we approach the asset class, and then maybe we can talk about what we saw last year, where we are now, and where the opportunity is, if that works for you and Romain. So just important to know about us, we've been doing this for 26 years, and that's important because 98% of managers in this asset class actually started post-global financial crisis. And so for those of us who've been doing it for 26 years, that means you've invested through multiple interest rate cycles, multiple economic cycles. You've had a lot of things go wrong. And so you've wanted to have the documents to get to the table and work out of those situations. It's a really important differentiation to have done it for a long period of time. The other thing I want to say about us is that we have a disciplined approach and highly differentiated outcomes. So as an example, we don't own any software.
Right.
And so people ask us, why is that? Did you predict you're going to have to help me with this. It's SaaSpocalypse, which we did not. But because we keep our leverage at about 3 to 4 times, and the market went much higher, and because we have documents, because we have very strong covenants, and because we stay disciplined on pricing, we just ended up not making loans to those companies. Or you could say they didn't want our money because it was expensive with a lot of strings attached. Both of those things are true, but that's how we ended up with something very different. So I think we can be objective about what we see from here. And so maybe we talk a little bit about kind of what went wrong. Would that be helpful?
That would be. I'm very curious, to hear where you're seeing the opportunities, and also, that does imply a degree of confidence that maybe we've seen the bulk of these accidents so far. Yeah, so I think it's also important to say, to keep this in perspective, private credit is effectively bank lending, which has been around since Mesopotamia. So if approached in the right way, it's going to work out just fine. This environment is going to, and all environments ultimately will reward disciplined lenders, and that's really what you need to look for. But there's no reason to panic here. We do think that just like it wasn't the golden age ever of private credit, now people are calling it radioactive. Like most things in life, that's not true. The truth is somewhere in between. And if you are with a disciplined lender with a lot of experience, you're going to be just fine in this asset class with great opportunities ahead. But I want to pick up on what you asked about in terms of what did we see and why were we worried last year? A lot of money came in quickly. And when a lot of money comes in and there's a lot of pressure to deploy it quickly, lending standards loosen. So it wasn't that we predicted some issue in a sector. We just said lending standards are loosening, and eventually that's going to show up with some challenges. And that's what's happened here. So now where are we? We are at a moment where manager selection is going to matter a lot. The beta trade is over. It actually is very easy to lend money. The harder part is getting it back. And so people who have positioned themselves well to do that are going to perform. I think we're also going to have, I hope we've done some learning around sector concentration. This is leveraged finance. We make mistakes for sure, and things go wrong a lot, but you don't want to be concentrated into one sector.
Well, I mean, since Katie went back in time to last year, you also said last year, you talked about the asset-backed financing market. I think you said $1.5–2 trillion market, even though the addressable market could be what, like 20 trillion?
Much bigger addressable market.
Much bigger addressable market. So how much of that have you gone after in the past year?
We have built up a great asset-backed finance business where we do do that in IG as well as more opportunistic. We have an interval fund in that space called TPay. We just reached our 1-year anniversary on it. And this is a good, so just taking a step back, you asked about opportunities generally. Asset-backed finance would be one. When you are late cycle, people, if you're worried about corporate credit, here's a way to get some yield, and you're taking a different type of credit, right? You're securitized against these cash flows, and you can invest across both the IG and the more opportunistic part of the market and produce a really interesting income stream. So this is a great complement to a fixed income portfolio. I just want to end by saying beyond that, in private credit generally, we also just see opportunity in new vintage direct lending, because if money is coming out, that means that you're going to be able to earn better spreads and you have a higher base rate. That's good. And then finally, we also see opportunities in rescue finance here. That's probably where we're deploying the most capital.
But on that point, and this is more of a risk question, and forgive me if this is a bit out of left field, but I am curious about your relationship, TCW's relationship with Nippon Life, and how that sort of relationship works in terms of discussing the amount of risk to take on at a time where there still is a lot of uncertainty as to how all this shakes out.
So we're very proud to have Nippon Life as a partner. They've been a long-term shareholder of TCW. So just for everyone's edification, TCW is a privately held company. This is one of the reasons why we produce such highly differentiated portfolios. Because we're privately held, we can think very long term. And we have some tremendous partners. Nippon Life is one. They are the world's largest life insurance company. Very proud to have them as a partner. And they are one of our largest clients too. And they are looking to, in their life insurance general account, like many life insurers across the world, they are looking for ways to diversify and pick up additional income. And so they are invested in our private credit products, both direct lending as well as asset-backed finance. And life insurers in general are really good matches for this asset class because of income needs and also because of the length of the liabilities.
And maybe this is out of left field too, but I've just been turning over.
I can't wait.
I've been turning over what you were saying about, you think about a lot of the folks who are now in this space, 98% of them, when it comes to direct lending, when it comes to private credit, they entered after the financial crisis. And I have to imagine, or it'd be really interesting to see what that number looks like when it comes to just the past 5 years. We were talking about tourists and private credit with Alan Schwartz in the previous segment. And I do wonder whether we're entering into an environment that could be conducive to more consolidation in the asset management industry, especially when you think about private credit and how many more managers there are there now.
The way that we think this is likely to work out, again, there's no reason to panic here. I do think that whenever the asset class experiences a moment of glory, which for us was, 20 plus years in the making, it does bring in new entrants. That's kind of the history of Wall Street, right? And so the way this is going to work out is that, yes, maybe there's some consolidation, some managers go away. I don't think that's going to be the majority of what's out there. There's going to be some folks that are going to produce mediocre average returns. And so some of those clients may say, do I really want to be locked up, pay these fees for those returns? There could be some of that reaction. And then there's going to be some people that really differentiate themselves in terms of returns and risk-adjusted returns. And, obviously we aspire to be in that group of people. So you're going to get back to this conversation around manager selection mattering. I also just want to make a plug here for public fixed income markets, which got left out. Which is, it is the largest market. It's something that we're really excited about at TCW. You guys mentioned at the outset that we've built out our ETF franchise. So we have built out our active ETF franchise at TCW. And the three main areas we're focused on is income, so I can talk more about how we're positioned in the liquid bond market if that's of interest, power, and AI. So which one of those should we pick up on?
Well, it's going to break your heart here. But
okay, are we done?
We're out of time.
Okay.
Katie. We would love to keep going here.
We just have to have you back as the only answer.
Should we do that in New York?
Yes, absolutely.
I'll be there this summer. I so appreciate the opportunity to be here, guys. Thank you so much.
And we really appreciate you having us, particularly in your hometown. Katie Koch there, the President and CEO over at TCW. I think she says she's coming back.
I feel hopeful about this.
Before your baby.
Yes, please.
All right, when we come back, we're going to talk the travel and leisure industry with a giant in that industry, Eric Resnick over at KSL Capital Partners. We're going to catch up with him when we come back after the break. Live from the Milken Conference here in Beverly Hills, California, this is Bloomberg. All right, let's talk the business of travel and leisure. Eric Resnick has spent his entire career at the intersection of mountains and money. He started at McKinsey, moved to Vail in the 90s, and helped run a KKR-backed hospitality platform before co-founding KSL Capital Partners back in 05 with a singular thesis that travel and leisure is one of the most durable growth sectors in the global economy. Eric joins us here from our stage here at Milken. Great to have you.
Oh, great to be here with you, Romain and Katie.
We talk about the durability of that, even, of course, with all of the talk right now about macroeconomic concerns. That holds up?
It really does.
Yeah.
And if you think about, those who, are fortunate enough to be doing well in the economy, and obviously the K-shaped economy is a real thing, but what they really want to do, they want to spend time with those they care about, doing the things they care about, and the number one thing they care about is experiences, health, wellness, and travel fits squarely within that.
I want to talk about your crown jewel, which is Alterra, the ski, kind of a roll-up of all these ski resorts into one, Icon Pass. You just had a big CEO change, or got rid of your CEO. Talk to me a little bit about the health of that business, not so much just from the consumer perspective, but also just from a cost perspective.
Well, Jared Smith did a great job for us for the last 4 years, and we're looking forward now to hiring a new CEO over the next 6 months or so. We're in that process. That business is incredibly healthy. It was not a great ski year, just to be clear, in the Western United States.
Well, Mother Nature was not working
Mother
on your
Nature
side.
was not kind to you if you lived in the West, and if you lived in the East, it was a great ski year and throughout the Northeast and the Mid-Atlantic. But we're actually still skiing at Camelback in the Poconos, believe it or not, today in May in Pennsylvania. It never happened before. But the cost pressures in that business are real. But fortunately, we've been able to have reasonable pricing ability to be able to pass those costs on and still be able to provide a great experience for our guests and to be able to continue to build out those mountains.
But I'm curious with the business model. Obviously, a big part of that business model was the idea of selling the passes, getting that money sort of locked in up front. Of course, people get grumpy when they realize, okay, I can't get to the mountain because, it didn't snow or there wasn't cold enough. And obviously, you're not getting really refunds from that. So how do you square that? Because at some point you do get pushback from your consumers.
Well, I think the consumer recognizes they're getting the benefit of a trade, which is they get incredible variety and the opportunity to ski really anywhere in the world. We have over 70 destinations on the Icon Pass. I mean, some of the best resorts in the world and in all the critical ski markets. And the trade for that is that they get the best deal if they buy it up front. They buy it in the spring or they buy it in the fall before the season starts. And so the trade-off for them is, they're taking a little bit of that weather risk in exchange for the great value that they're getting up front. And I think overall, even in a year like this year, the average person who bought the Icon Pass is still going to be skiing about 8 days, which is still a great value for them. And certainly we hope that next year they're skiing 10 or 12 days and getting even more value out of the product. And I suspect they will.
Well, weather aside, I do want to talk a little bit more about geopolitics, because you can have a conversation around fuel, but then there's also just, the human concerns about traveling right now, especially when you take that global perspective. And I wonder if you're seeing any sort of ripple effects from that, any changes in behavior from this 2-month war.
You are. I mean, you generally, the WTTC generally says that when you have geopolitical upheaval, it takes about 2 months to recover. And in fact, that's exactly what we're seeing. At the trough, we saw bookings down 16% across all of our hotels and resorts that we have around the world. This past week, we were up 8%. So it's taken about 2 months. So we went from, we were +5 to start, down 16, now +8. That's week over week, meaning back to last year. And so we're still +2 for the year at this point. So we think that, yes, there's been shifts. International's down more than domestic. So the consumer's still traveling, but where they're traveling is shifting a bit. The American consumer that last summer was going abroad a lot, this summer, I suspect you're going to see them stay a little closer to home. And so you'll see puts and takes, but overall, the overall demand picture actually is still quite healthy.
All right, Eric, we have to leave it there. Really appreciate you joining us today.
No, great to see you guys. Thank
Eric
you.
Resnick, the CEO over at KSL Capital Partners. About a little after 11:30 here in Los Angeles. We do want to check in New York with where equities are. And Katie Greifeld, we are setting up for yet another record high. I mean, we talk about the concerns about what's happening in the Middle East and the macroeconomic picture here in the U.S. And yet for investors right now, this is still about corporate earnings, and they're still there.
Yeah, much different photo than what we were looking at this time yesterday. The S&P 500 higher by about 0.9%, and you can see that it's big tech reasserting itself, higher by about 1.5% when it comes to the Nasdaq 100. It probably helps if you take a look at the bottom of your screen that you do have Brent Brent lower by about 4% today.
This is somewhat of a narrow rally, too. We should point out the Philadelphia Semiconductor Index up about 5% right now. So a lot of people piling back.
What about the transports?
In the chip stocks, and they're there. Thank you, Katie. You caught me off guard. Transports are up 2%. How about that?
Kidding.
Yeah, look at that.
Wow.
I should just highlight that one in yellow for you here. But that's a quick look at the public markets. We do want to continue, though, given where we are here at the Milken stage, talking about what's going on in the broader markets as well, in the private markets, too. And that brings us to our next guest. Hepsen is the Americas CEO over at DWS, the Deutsche Bank-backed asset manager with more than 1 trillion euros under management. And the U.S., it's the firm's top growth priority, and Hepsen is in one driving it, overseeing the expansion of X-Trackers. That's ETFs, Katie Greifeld.
Indeed.
Europe's third largest ETF platform, and they're actually moving into the U.S., plus a $100 billion euro alternatives business spanning infrastructure and real estate. Hepsen, great to see you again.
Great to see you, Romain. Thank you for having me.
So you took over the Americas business, about 16 months ago. I don't know what playbook you came in with, but a lot's changed over the last 16 months, as you know. Has your vision changed?
No, I think in these markets, being disciplined and consistent is the key. We continue to give the deliberate message as we did after our first quarter earnings.
I know you're building out the Americas business, but I do want to talk about the products you have in Europe, because there has been a lot more interest in those products, given what's transpired over the last 16 months, from the whole tariff issues last year to now what's going on in the Middle East. Europe defense tech is hot. A lot of European defense sectors are hot right now, and you're rolling out new products in that space.
Well, when you look at our X-Trackers franchise, you see that a lot of people are actually getting out of the traditional asset classes. For example, when you looked at our World ex-US ETF in actually Europe, has tremendously grown closer to almost $8 billion. So those are the asset classes. So people are not getting out of ETFs. They are being more deliberate and demanding more from the product line.
Well, as you know well, I mean, the ETF industry is fiercely competitive. And I wonder, how you're positioning X-Trackers. When are you thinking about distribution, when you're thinking about potentially model portfolios and the like? Because you think about the U.S. again, that Eric Balchunas of Bloomberg Intelligence calls it the Terror Dome, and Europe as well is also very, very cutthroat.
All of the above. I think the product manufacturing is critical, but it's your reach, right? And it's your credibility. When you think about what's happening right now and what we are hearing at Milken is, I'm sure you heard about the private credit, but one of the things that's basically emerging is also, how about global markets? Is U.S. actually paused? I think it's not ending, but in global markets, I think the individuals are pausing on U.S. market. And that's a huge opportunity for DWS, because we sit at in the middle of Europe and U.S. We have Deutsche Bank heritage, deep U.S. franchise, and expertise.
How does that stack up against, when it comes to what we've been talking about, when it comes to energy prices, the idea that the U.S. has been pretty well insulated from this energy shock that we're seeing unfolding around the globe, but it's a different picture when you take a look at Europe. Of course, much more directly exposed to what we're seeing there. Certainly diversifying out of the U.S. has been a great trade over the past several years, but, how much runway does that truly have left if we see this conflict in the Middle East continue for the next several months?
I think one of the biggest lines that I heard here is that what's going on at Hormuz been priced in yet? Because as we know, energy prices impact the earnings, and that will be an impact to how the markets will be reacting. And I think for Europe, that is critical. And that's why we have the deep expertise to make sure that we will shift our strategy accordingly.
Is this a sort of a structural shift, though, too, in terms of what we're seeing? And are you seeing more U.S. investors really pursuing that geographic diversification outside of the U.S.?
Exactly.
Yeah.
I mean, when I hear about from institutional clients, it's not like how much more U.S. Is that what's next? And I think that's a structural shift that we haven't seen for more than 3 decades. I mean, Japanese rates are real. European rates are very competitive.
Yeah.
And I think investors are paying attention to that.
What about U.S. rates? I mean, the general consensus here is that we're going to see downward pressure on Fed rates, presuming that Kevin Warsh gets his way. I guess, how does that affect your business, if at all? But more importantly, how does it affect that reallocation of capital?
Well, look, I think ECB has much more room to navigate than the Fed has, and that definitely plays into our hand. And like I said, I think the impact of what's happening in Middle East has not really been priced in. And I think that's what's being talked about in the private markets right now. And I think in the private conversations that I'm having in Milken, people and smart investments are moving out of U.S. Again, it's not outflows from U.S., but how am I locating my inflows? I think that's the conversation we should have.
Interesting. Well, I mean, when you think about the whole world outside the U.S., that is obviously a very big umbrella. I mean, talk to us a little bit about what you're seeing for Europe, for example, versus emerging markets or Asian economies, or where are you seeing that interest when you do have those conversations about diversifying?
As you know, we opened our Abu Dhabi office over the last year, and we're having very constructive conversations with our Middle East investors, and that is real. And a lot of our investors, especially from APAC and Middle East, are very much interested in our private credit and infrastructure business focused in Europe. And that is definitely a shift that I'm seeing.
Well, compare and contrast, all of the noise around private credit when it comes to U.S. markets versus, the demand and the conversations that you're having around private credit when it comes to Europe. Are you seeing those same sorts of concerns come through?
Not exactly. I think that there's a pause. And when I think about actually the concerns that are being private markets, I don't see that as systemic. It's more about, I think, the credit markets maturing, right? I think what I'm more concerned about is the democratization of alternatives. Has that gone too fast without actually the investors being educated enough? I think that is what we are seeing right now. And if you look at the first quarter, the private credit, obviously, outflows impacted our, for example, high-yield ETFs as well. Not because there was actually a systemic problem, but it was the noise. So I think the alternatives investor education, especially in retail markets, is going to be critical. That's what we are being very, very deliberate about. And also I want to highlight about what's in everyone's mind, right? Right now it is incredibly important as investors for us to be disciplined. That means income and liquidity. And the income needs to be actually coming from 4 asset classes, right? Short duration credit, municipals, real assets, and infrastructure-linked investments. Those are the 4 areas that we have deep expertise in DWS Americas. So that's what I'm really, really focused on.
All right, Hepsen, that's a good place to leave it. Really great to get some time with you. That is DWS America's CEO, Hepsen Uzcan. Really interesting conversation. And it's interesting to hear, and this is a common thread, all of this focus on income. Even still, when you have the S&P 500 at all-time highs, you have credit markets pretty much, not, some would say complacent. Income.
It's called cash.
Yeah.
Cash is king.
People want it. I know. But, you take a look at the S&P 500, the time that we've had, typically you think about income as being a little bit more defensive. So still that bid out there.
Yeah,
but
good point.
Still ahead. We're going to talk about how Fortress is shielding its portfolio against AI crosswinds and market swings. Jack Neumark, he is the co-CEO of Fortress Investment Group. He joins us next. This is The Close on Bloomberg.
All right, let's get right back to it. Marcelo Claure is one of the most connected operators in tech and private equity, the former CEO of SoftBank International. Before that, orchestrating that $26 billion Sprint T-Mobile merger. Today, he's a partner and co-chair over at Brightstar Capital, founder and CEO of the Claure Group, vice chairman of Shein, and the largest independent shareholder of T-Mobile. Marcelo, great to have you here.
Great to be here. Thank you for it.
I want to talk about AI, and not so much as the AI build out, but how AI and that technology gets integrated, particularly into your portfolio companies, how fast that is going, and more importantly, what's the purpose?
So I think the time of the application of AI has arrived. I mean, if you look what has happened over the course of the last few years, everybody's been investing in what we call the AI factory. Data centers, semiconductors, power, LLMs, applications, all the exciting development of what I believe is the most powerful technology. But now the time has come of how do we apply that technology to our businesses. If you look at the numbers are huge, right? If you look at the latest McKinsey estimate, they say that the value of AI will reach up to $8 trillion in P&L impact per year. I mean, multiply that by multiples, and that's a gigantic jump in our GDP. And what's interesting is they expect that 70% of that will go to incumbents, to everyday businesses. So I think the time has come now for that technology to be able to be applied to businesses. And I think you're starting to see some amazing development, I think, over the course of the last few months. And the future is going to be about the application of AI.
Well, I am curious about what you're investing in and how you look at it, and particularly in light of the news that Eric Hepsen over Davison Kempner is joined earlier this month here. What does that signal about where you want to take Brightstar?
I mean, obviously, we joined Brightstar because when you have a technology revolution like the one we're having right now, this will become an exponential opportunity for some, hopefully for us, an existential crisis for others that are not being able to adopt this technology. So what we're doing is we're building a great team. I think bringing Eric to the team is an incredible accomplishment for the management team of Brightstar. He's one of the leaders in the private equity space, and having him take a prominent role within our private equity is an important piece. It is only the beginning. We have a lineup of stars who believe in our strategy. Our strategy is very simple. We buy good businesses. We apply operational transformation like we've done at Spring, like we've done in many companies in our career, and then we do an AI intervention. We were able to see firsthand.
An AI intervention.
Yes, and we've been able to see firsthand this. We've seen it in T-Mobile. T-Mobile is probably one of the leaders in terms of applying AI into their business.
Right.
We were the early starters at Sprint when we started using AI, when AI was not such a thing. And I was very lucky to be part of SoftBank in a time where we started talking about AI in 2014, 2015. We talked about the concept of singularity, which today has finally arrived. So I've been lucky to have seen what AI can do to businesses. So now the time has come to buy good businesses and make them great by applying AI both in not only in cost, in productivity, increasing revenue, and so many different areas where AI will be a game changer.
Well, let's talk about that a little bit more. You know, the playbook you have of AI intervention, I believe you called it. It sounds like basically infusing AI to boost productivity. What types of companies have you found are most ripe and stand to benefit from that?
Let's make sure that people understand the technology is ready and technology works. So the first business that we bought is in the UK. It is the UK's largest for-profit university. It's Arden University. It has 50,000 students. We did a partnership with some of the leading large language models companies, and what we're doing is we're redefining the entire journey of students. First thing we're doing is every single student that graduates now graduates with an expertise in AI. When I hire people at any of our companies, the first thing that we ask you is, how well do you know AI? How well do you know how to apply AI in your field? You know, when you hire, now when a psychologist comes through our curriculum, we teach that psychologists how to use AI in their field. And as we hire people, if you listen to Jensen speak the other day, he says, bar none, the people are going to be hired, the people that know how to use AI. One of the hottest jobs today, we call it the master agent, is the one that knows how to make agents and manage agents. So that's an important piece. Secondly, we're redefining the entire journey. We're recruiting people now utilizing AI agents. We're onboarding. The interviews are going to be done by an AI agent. And more importantly, as we teach students the future, now we're going to start using personalized learning. We've been teaching people the same way for the last 2,000 years, and that is one size fits all. With AI, it gives you the ability to teach you based on your skill set. So that is the first deployment of AI that we're doing. We're also doing it at the educator. I mean, 50% of the time an educator spends, they spend in non-value-added activities, marking, grading, and all that. AI can do a much better job than that. So that's the first business. We have a lineup of businesses that we're buying, that we plan to buy. And we look at businesses where technology is ready, and we can apply AI to create massive efficiency in the business. But not only that, I mean, you're talking about growth in the business.
Well, Marcelo, we only have a minute left. I want to talk about your pipeline a little bit more, because in the notes you sent over to our producers, you highlight the middle market specifically, and I wonder what you see there.
So what we're featuring right now is middle market and upper middle market. Those are companies, that's the foundation of America, that's the foundation of the GDP of this country, and traditionally those are companies where technology doesn't get there first. So we have chosen a segment where we plan to apply technology, we plan to apply AI, and these are businesses that range between $200 to $500 million in profit. They have a good data set, and you know, when we do a complete buyout, you basically take control of that company. We have identified a very large pipeline of companies. There's over $105 trillion of family-owned business in the United States. And you know, if I leave you with something, think of Brightstar as the way private equity used to be, right? You buy a business. Financial engineering is not our core. Modest improvements are not our core. Our core is buying a business and make it great by doing operational transformations, and more importantly, by applying AI at the top. We've learned how to do it through our careers for the last 30 years, and now we're focused on this.
All right, well, that is a good place to leave it. Marcelo, great to get some time with you.
Thank you.
That is Marcelo Claure. He is the partner and co-chair at Brightstar Capital. And I actually bumped into Jensen Huang yesterday.
Did you really? You didn't tell me this.
Well, I was coming off of my panel. He was about to start his, and actually had to ask him to move so I could get to my phone.
Oh, okay. That was the entire interaction?
Yes.
Well, his speech was actually, I mean, the panel he did was all the talk here. Right?
Yeah.
I mean, when I came in this morning, everyone was just talking about how optimistic he was. I mean, and as you would expect, but the idea of just really being able to articulate that optimism, and we know that the AI story, it's broadened out beyond chips. We're going to hear from another chip maker later tonight. We're going to get some earnings out of Advanced Micro Devices, which is, of course, trying to make its mark in the AI world itself.
Yeah, big time. You can see the shares rallying in anticipation of those earnings. It's going to be interesting to see them land in just about an hour or so's time, up about 4%. Also going to hear from Live Nation, as well as Super Microcomputer. Very interesting story to follow. A lot of twists and turns. We're going to get some fundamentals from them.
We're going to find out if it's still super, and we're also going to find out if strategy is still micro or macro. What's going on with your boy?
Yeah, I don't know, man. But strategy, you can see shares higher by about 1.4%. Of course, we're talking about the largest corporate backer of Bitcoin. But let's get to our next interview with the man in charge of a firm with roughly $55 billion in AUM. His name is Jack Neumark. He is the co-CEO of Fortress Investment Group. Joining us now, Jack, it's great to see you.
Thanks for having me on.
So let's talk a little bit about asset-based finance here. I know that, you're coming off a panel on that very topic. We were talking with Katie Koch over at TCW to kick off the show and talking about the big opportunity she sees there. And I'd love to hear your thoughts on what this moment means for ABS and why now.
Yeah, so maybe just to draw a little bit of distinction, ABS is a great market. Spreads have been super tight on the public side, so we have definitely not been as active in the ABS world. On the ABF side, which is what people are generally going to call private asset-backed deals, we're looking still heavily at consumer opportunities, unsecured and secured consumer. We're looking at a lot of resi opportunities, and we're looking at commercial real estate opportunities. We think all of those areas continue to throw off really good yields, and we're comfortable with the risk right now.
Interesting. And I want to get back to, what it says about this moment. Obviously, we're talking about a moment in time where private credit jitters have really permeated. And the fact that you are seeing this sort of renewed interest in these more guaranteed streams of income, what does that say about the environment overall?
Yeah, I think, investors are becoming very comfortable with the idea you can have assets in a box in an SPV, and instead of relying on generating a recovery by, being able to sell a company back into the market in what's been a really tough M&A market with a lot of question marks on valuation, you can simply allow your collateral to liquidate over time and pay you back. And I think people like that comfort. They like knowing that their protection is sitting in a box that's protected when they look at the comparison to private credit. That being said, I think private credit still is an interesting area. We're still very active on the direct lending side, just picking our spots and more in the core middle market area.
I am curious, though, we talk about the broadening out of alt assets into the wealth channel here. You just launched your Fortress Real Estate Exchange, which is, I would assume, a direct play for that wealth channel here. What's the education process like for the advisors and ultimately the end buyer?
Yeah, I mean, I think on the real estate side, for retail investors, they've been pretty educated over real estate products for a long time. The DST product is a little bit newer. We're not the first to come out with it, but I do think there is a lot of understanding as compared to the multi-strat and the private credit vehicles that I think are still newer in this scheme of retail investments. REITs have been around a long time. I think investors understand that dynamic. So for us, it was a really great area to lean into. I think with the sort of real estate depression that happened over the last 5 years, there's been a lot of opportunity. It's an asset class investors know, and now as they think about where they want to allocate, it's a great place for them to be looking.
I am curious about where Fortress goes. I mean, obviously, the company went through a lot with the loss of Josh, the previous leader. I think you're now, something like more than 60% of the companies now owned by Mubadala. Is this sort of a signal that you're going to take a much more international focus going forword?
Yeah, I think we've been in the markets a long time. We've been around 25 years. I think a lot of alts managers have had one ownership structure for their entire time. For better or for worse, we've had a lot of different iterations. We were a private company. We were a public company. We got taken private by SoftBank, and then we bought the company back with Mubadala. I think from our perspective, we're in a great spot because management now owns a significant amount of the firm. And when we think about growth, we're trying to balance the opportunity set with our ability to continue to deliver for our LPs and our employees. That's going to mean steady growth. I don't think that's going to mean international expansion. We're going to be in Europe, in the United States, Australia, Japan. That's going to be our main focus, along with maybe a little bit in the Middle East.
And when it comes to the Middle East, I am curious, you think about the geopolitical happenings of the moment, this 2-month war that we're seeing. When it comes to Middle East investors, is the appetite still there?
Yeah, I mean, in my conversations with them, I think they seem super excited. Some of those Middle Eastern investors are the most sophisticated institutional investors in the world. They have a significant amount of capital to deploy, and I think they know their spot in the market, and they can really generate a lot of opportunity for their sovereigns by investing. I've not seen any slowdown from them, so we'll have to see how the situation plays out. It looks like the truce is holding. Who knows how that plays out day by day, but the investors I meet with are still very active and engaged.
All right, Jack, great to get some time with you. Appreciate you stopping by. That is Jack Neumark. He is the co-CEO of Fortress Investment Group. Let's take a quick check on these markets right now. It's just about noon in LA. That means we have an hour to go until the close. I finally worked out that time difference, Romaine. You can see that if all goes well, if this rally holds, we should finish the day at record highs on the S&P 500.
It's kind of interesting, too. We talk with a lot of folks here about sort of where they're surprised about the resiliency that we've seen in public markets and in private markets, for that matter, and the idea as to whether risk, the real risk of what's been happening overseas has actually been priced in. I know Katie Koch had some pretty strong opinions about that maybe we could potentially see a reckoning down the road. But for at least right now, folks seem to be happy to make money where they can, and they've certainly made a lot over the last couple of months.
Yeah, and she's certainly not alone in that view. But again, this equity market continues to rip higher. But let's get to our next guest, because his career stretches from the White House to Wall Street, previously serving as the U.S. Deputy National Security Advisor for International Economics under the Biden administration. His name is Mike Pyle. He's now the deputy head of the portfolio management group over at BlackRock, overseeing its hedge fund platforms, fundamental equities franchise, and the BlackRock Investment Institute. I'm still going, and
Sorry about that.
I feel like I still could. Mike, it's great to see you.
It's great to be here. Thank you.
I want to talk specifically about the hedge fund business, which, as I ran through, falls under your remit, because you came out with a hedge fund reports from BlackRock, and I think it's really interesting that, one of the first bullet points is you make the case that hedge funds can replace traditional sources of portfolio ballast that are becoming less reliable. I feel like I spend a lot of time trashing bonds because they haven't really been that reliable source of, a haven asset. And talk to us a little bit about the connection there, how bonds have been behaving, and how maybe hedge funds can replace that.
Sure. I think that's a question that's on the front of the minds of a lot of our clients and investors around the world. If you think about it, the world we're facing today, a world confronted by COVID, by energy shocks in Russia, Ukraine, and today with Iran, by the transformations of AI, it's a world that's really being buffeted by supply shocks. It's a world that inflation is a much bigger question mark than it was during, say, the 2010s. And as a result, because of those question marks around inflation, the correlation of bonds to stocks is just looking a lot different and a lot kind of more positive than it did during that prior decade. That means that the diversification we came to rely on from bonds during the 2010s, when it was really comfortable to run that balanced portfolio between equities and bonds, it's just a lot less comfortable today, and investors are short sources of diversification as a result and needing to find alternatives that can provide the type of diversification they need in portfolios.
Well, I cover ETFs for a living quite closely, and, it's interesting. I think back to December of 2024, there was a really interesting article that you think about the University of Connecticut's endowment. They basically turned away hedge funds. They dumped hedge funds from their endowment and went instead into buffer ETFs, which, of course, you give up some upside for downside protection. Of course, BlackRock has a few of them, but it does raise the question, why put your money with a hedge fund manager with those fees when you can get a defined outcome and sort of replace that bond hedge with a buffer product?
Yeah, I'd say different types of investors are going to find and source diversification in different ways. But I would say one of the interesting things about hedge fund strategies right now, we talked about diversification. There's another D that I keep front and center in my conversations, and that's dispersion. If you look at dispersion in markets today, the gap between the highest performing names, assets, and the lowest performing names and assets, it's bigger today than it has been for a number of years. Think about the divide between semiconductors and software over the last couple of months. That increasingly wide band of dispersion is an increasingly large opportunity set for long-short managers, especially in the hedge fund space.
Well, and on that point, though, too, I mean, you've spoken before about this idea of kind of these two big supply shocks going on, one with AI and the other with energy, and use that as kind of a case of why a more traditional hedge fund model actually might be more relevant here. Talk about those two competing things here. Are they sort of in tandem, or are these going to be sort of consecutive events that we can deal with in a consecutive way, or do they have to be dealt with together?
I think the fact is that they are going to be repeated features of the landscape in terms of what's shocking markets, what's shocking the economy. And again, what they have in common is that they shock the supply side of the economy. They shock uncertainty around what's the inflation picture going to look like, and as a result, what's that stock bond co-movement look like. All of that means finding alternative sources of diversification is key, and being able to harness uncorrelated alpha can be a key part of how you build that diversification portfolio.
Are these shocks going to become a little bit more routine, if you will? I mean, I just think about your time in the Biden administration, your response, of course, to the Russia energy shock, and here we are, 3 years later, talking about this again.
Yeah, I mean, I think that it's a really common feature of the post-COVID world. I mean, we've seen this, as a result of successive energy shocks. I think the build out of things like AI requiring like the ability to marshal different types of resources around the world, sort of atoms, not bits, even if what it's going to is the digital economy. That kind of need to build in the physical world, that the chokeholds around supplies in the physical world leads to the regularity of these types of shocks. It's been a part of the last 5 years.
What is the leadership, though? I mean, shouldn't government leadership sort of buffer people from this to a certain extent? I mean, is there a policy prescription for this?
I think what you're seeing actually is increasingly governments turn to stockpiling as one type of response to these type of shocks. If you roll the clock back again a decade, the U.S. and others were selling down their strategic petroleum reserves. Today, we see things like the Strategic Petroleum Reserve being, both here and in other countries, a key source of cushion, a key source of stability in a world where energy shocks are potentially going to become more common. And I think that theme of stockpiling is extending to other critical inputs as well. And it's something we're going to see policymakers do more of, companies do more of, to provide that kind of cushion in the face of these types of shocks.
Absolutely. And, it's interesting, too, when you think about the sort of the geopolitical, I don't want to, use too many metaphors here, but it feels like chips in particular and compute power has really emerged as sort of a geopolitical flashpoint as well. You think about the U.S.-China relationship. Now we're more focused on what's going on with Iran, but, that was really at the heart of a lot of those tensions there. And I just wonder, if you see that reemerging, when you think about, the idea that the U.S. is short on chips, it is short on compute power.
I mean, I think that AI is going to be one of the key geopolitical questions of the next year, the next 5 years, the next 10 years. And I think there's both a dimension of the capabilities of AI, but also, as you say, the dimension of the inputs that go into, building and powering AI models. But I think, again, to go back to markets, it just highlights that there's a lot of really powerful forces coursing through the supply side of economies around the world. And that means making diversified portfolios is a harder problem for investors to solve. And there's a role, an important role for non-traditional exposures like hedge funds that can provide more uncorrelated streams of risk and return that complement traditional exposures like equities and bonds.
All right, fascinating, Mike. We've got to talk a little bit longer at some point in the future. Mike Pyle, Deputy Head of the Portfolio Management Group over at BlackRock. Meanwhile, we check back in with the markets. It is about a little after 3 p.m. New York time, Wall Street time. Stocks holding on more or less to the highs of the day here in S&P 500, trading around those record highs. So too is the NASDAQ. not a whole lot of movement in yields, but look at that drop that we've seen in Brent crude, and this gets to the volatility, right? Yesterday we were up, what, 113, 114, and now here we are back below 110.
Yeah, it might be one of the reasons why you are seeing stocks being able to rally to these record highs right now. But you just think about the levels. I mean, 110 on Brent or thereabouts. Think about 2 months ago, that would have been quite a scary stat. But obviously markets have sort of more or less adjusted to these types of valuations.
And we talk about that volatility there. Again, the volatility in the equity market, at least if you look at what's being priced forward, the VIX, that's still around 17, 18 here. So not huge pricing, at least for the next 30 to 45 days. We keep our conversations going here from the Milken Conference. And we do want to talk about some of the real tension right now in the alternative asset space between democratizing access and maintaining return quality. Asset manager Sagard is leaning into that, going from a few $1 billion in AUM to over $45 billion in under a decade, and is now actually targeting a tripling of that. Sagard CEO Desmarais joins us right now. Great to have you here, Paul.
Thank you. Thrilled to be here.
Absolutely. Let's talk about kind of this democratization, if you want. Retailization, I think, is a phrase I've heard a Sagard use in the past, and whether we're actually really ready for it.
We're really excited about this theme, and it's one of our 3 key themes at Sagard. Consolidation, democratization, and AI. We think that diversification is the only free lunch when it comes to investing. And I think it's a problem that many people in America do not have access to what is one of the most important and highest performing asset classes today. If you look at their parents, they benefited from defined benefits plans.
Yes.
Those had large allocations to alternatives, which gave them a great retirement. I think for our generation to have that same opportunity in retirement, having access to private equity, private credit, infrastructure, real estate is extremely important.
But there was a big difference with those defined benefit plans. I mean, it wasn't the individual more or less making the decisions about what to invest in. You had an experienced asset manager, hopefully, on the other side of that. It's a little bit different now because you're now relying on what the advisors, and more importantly, let's face it, there's a lot of salespeople out there who are just saying, hey, take this, you're going to get this return, and not really explaining the illiquidity of some of these investments as well as the potential risk.
What you're saying is extremely important. And I think there are 2 things that are essential for this democratization to happen. One is the role of the financial advisor has never been more important. Understanding a client's liquidity profile and what are the liquidity needs in the near and medium term is really important. And for many clients, illiquid assets will not be an appropriate allocation. The other thing that's really important in this space is designing a new set of products for those clients. The traditional products, the 2 and 20 structures with concentrated portfolios, are not appropriate products for these clients. And so a new type of product, whether it be through target date funds or through a whole other range of product innovation that I think will happen in the coming years, are going to be essential, especially when you're going down market, for example, in 401k plans. I think that product innovation is even more important. The value of advice paired with product innovation, I think, will lead to great outcomes for individuals in the long term.
Well, when you think about different products, you think about different vehicles in which to access, you know, it seems like some of these interval funds, these non-traded BDCs, again, learning hard lessons about liquidity. So, I mean, when you think about designing those sorts of products, how do you make sure that it's actually being communicated? You said that the financial advisor is very important here, but clearly you can make the case maybe something went wrong in the first quarter.
You know, that is a great comment. And the reality is all of these vehicles are designed with the opportunity for 5% liquidity. I think for many people that was maybe not communicated or not understood. And I think it's going to be really important for financial advisors to spend a lot of time with their clients understanding their liquidity profile and understanding, you know, and communicating that that 5% is likely going to be the maximum that's going to be allowed in a quarter. And so if you look at the gating of a lot of products, that's really to protect their clients. I mean, it is in many ways like a fiduciary good habit to basically stop outflows at a certain level.
And so, you know, you think about, again, the sort of liquidity tantrums that we saw in the first quarter really focused on private credit. So when you talk about this democratization of private markets, that's a big universe here. So what types of asset classes are we truly talking about? I can't imagine it's all private credit.
You know what? It's actually many asset classes. I think private credit's got a role. Historically, we've had a lot of evergreen real estate funds. Many of those are gated. Private equity, private infrastructure. The reality is private credit is actually one of the most liquid asset classes. And so there is a contractual return of capital in many of those loan agreements. And so as a result, I think the private credit space is in the bullseye right now. But in reality, I think that many of these people are gating more as a result of fiduciary duties than a real stress on liquidity.
And just real quickly here, you brought Baird in, right, to help with that U.S. build-out?
Yeah, so we are partners with R.W. Baird, and we are going to partner with them in their distribution. We are also partners with Empower Retirement.
Right,
in the 401k space, which was really at the forefront of trying to bring private asset classes into the 401k space, which I think is actually an ideal vehicle because talk about long-term assets. You know, people's retirement savings is really, I think, where these allocations should be. But again, product design is going to be very important.
Thanks, Paul.
All right, Paul, got to leave it there. Great to get some time with you. That is Paul Desmarais. He is the chairman and CEO of Sagard. And it's an interesting point. I mean, you think about 401ks, typically you're not supposed to be tapping that all the time. So maybe that liquidity want
at all until you retire, more or less.
Isn't as high there.
Yeah, but again, it gets down to education. That's one reason I wanted to ask about, you talk about how important this advisor channel is going to be and having the proper folks here and making sure that advisors are educated, Katie.
Yeah, absolutely. Yeah,
ETFs are going to be in there too.
Yeah, I don't know. I don't know about the liquidity mismatch there, but trust that we're going to continue to have that conversation. And coming up next, our live coverage from Milken. It continues after the break. We're going to have a great conversation with the chairman and CEO of Barings. His name is Mike Freno. Don't want to miss it. This is The Close on Bloomberg.
All right, you talk to anyone around Milken, and they'll tell you there are three big structural trends reshaping asset management. I'm going to count them out for you, Katie.
Yes, please.
Consolidation, partnership models, permanent volatility.
Right.
We were talking about that a little bit with Mike Pyle just a little while ago. We continue that conversation now with Mike Freno. He's the CEO and chairman of Barings. He's running a $481 billion platform at the epicenter of it all. And he joins us right now. Great to see you, Mike.
Good to see you guys. Thanks.
I do want to start off with that last one, permanent volatility. We were talking with Mike Pyle over at BlackRock, and he kind of talked about this idea, the energy shocks and now the AI shock, whether it's good or bad. But the idea that these types of disruptions, if you will, are going to become a much more of a recurring feature of the investment landscape going forward. Do you see it that way?
Absolutely. And I think we go through time, and you do this long enough, you see periods. We've had more, I think, closer together than we've had historically. Usually they'd be spread out more and more. But as information becomes more readily available, you're hearing about these things more real time. And I look as we as credit investors are looking to, primarily credit investors, looking over the long term, we've got to underwrite things through uncertainty. And I think when you think about all the factors that could do that, you've got to be with the mindset of the downside, protecting against the downside, irrespective of what the external markets will do.
So amid all this uncertainty, there was no pullback, no pause at all in what you were doing?
No, you may change your perspective. But again, when if we're in our lending businesses, we're looking at lending to 5 to 7 years. There's a lot that can happen over there. And so as credit investors, we tend to be just looking to protect the downside. Maybe some would say pessimistic a little bit at the side. So you're always anticipating something to happen. And so your underwriting standards are really to make sure that you can weather those storms.
Well, I do want to get back to the conversation we've been having about redemption requests. Obviously, Barings saw some of that in the first quarter. I believe your Barings Private Credit Corp funds had redemption requests of about 11%. And I wonder, from where you're sitting now, it feels like on a headline level, things have settled a little bit. But, I mean, would you expect to see those requests be elevated for the next quarter, a few quarters from here?
Yeah, it's hard to say. I think one thing we look at and we remind investors when we talk to them, the importance of this and the conversation we should be having is how has the underwriting been and how is the performance of these assets? It's certainly, in some respects, these have less liquidity than other assets, and there's a reason that there is a premium that's afforded to investors for this. It's the illiquidity premium, and the structures that have been built to somewhat limit redemptions to 5% are really meant to protect. It's not a bug of the structure, it's a feature of the structure. But we look at it and say, is the performance of the overall portfolio, are the underwriting standards of our investments as well as our competitors in the industry going well? And we think they are. We're not seeing a lot of concentrated pockets of weakness in our companies. I think the economic information is more mixed than it's been, but it's generally supportive of credit. And so it's very hard to say. I will say that on the institutional side, we continue to to see inflows. So there is a difference between what's happening in the retail space and what's happening in the institutional side of things.
It's an important distinction, and you know, it's a point that keeps coming up. Sort of the difference in demand when you take a look at institutional investors versus retail, and I do wonder how you see retail in these products sort of evolving, whether or not, you know, these semi-liquid vehicles with these 5% redemption caps, whether or not that's appropriate for the individual investor.
It depends on the individual. So I think with everyone, we look at it in a lot of ways. And what is the liability structure? What is the liquidity need of someone? I'd say even individuals have liabilities that in the future they'll have to meet. And we save for retirement. We call it retirement spending. Insurance companies have liabilities, pensions. And so I think when they have to balance what liquidity they need for future returns, that's got to be a suitability discussion between them and their advisor. And I think the products will evolve more, but I do think the structures, again, they will evolve over time, but I do think limiting liquidity is the appropriate structure for these over time.
I'm curious, you talk about that illiquidity premium, but that's been an issue too. I mean, when we talk about the spread compression, there's been a lot of debate as to whether you're actually getting a real premium. And then, of course, if you are comparing and contrasting that with public markets, which continue to be on fire, I mean, you can make maybe potentially 20% just, you know, riding the S&P up.
Sure.
That puts a lot more pressure on the private credit side in terms of what they're offering and, you know, what they're offering to lock in for a longer period of time.
Yeah, if we want to compare public markets and the debt side with private markets on the debt side.
And I know that's not fair, but people are doing it.
But no, it's a topic of conversation. Sure. So we look at it and we've built our business to have both public and private capabilities because we know capital will be efficient. It'll move around to the right spots. And certain borrowers, whether it be for purchasing buildings or whether it's be a corporation, will go where the capital is most appropriate for them. It could be that they're looking for the tightest spreads, and that may be offered in the public markets or maybe offered in the private. It could be they're looking for ease of execution. They're looking for one lender to do things, or they're looking for certain things in their documents. So I think what we've tried to do is build a business that at any point in time, capital may be flowing into private assets. It may be flowing into public assets. Neither is inherently good or bad. They're just different at that period of time. But I do think it's dangerous to say there will always be great opportunities here and never any good opportunities over there. We think it's going to be much more balanced. And just like volatility, it will move back and forth.
With regards to the structure of your business, we talked about at the start this idea of consolidation in the industry. You made a few acquisitions of late, Artemis, Griffin, Altice. I'm probably forgetting a couple of others. Is that the way to thrive in this space now, is through M&A, through consolidation?
I think it's a combination. Yeah. I think there's certainly organic builds that take a lot longer to do, and so we have done that. Our middle market direct lending business was built organically. We started in 2012, so way ahead, but it takes some time. We will hopefully be an acquirer, continue to be an acquirer of things that complement our portfolio of capabilities going forward in the future. And I think large scale M&A will happen over time. It's difficult in this industry. These are hard to do. This is the people business. You've got to make sure that the cultures fit. You got to make sure the expectations are aligned. But with the support of our parent company, MassMutual, and we announced that we were bringing in another minority owner. Hopefully that will close in the next couple weeks. We look to be acquisitive over time.
Well, I'd love to talk about the industry at large because, you know, what we keep hearing is you want to be selective with managers in this environment. And I do wonder whether you see a broader shakeout beyond, of course, at Barings and you're acquisitive, but whether or not you think we're going to see consolidation among some of your peers as well.
I do think, and I think we've seen a lot of clients, and this has been a trend that's been going on for a while, they want to do more things with fewer managers. It benefits them from a relationship standpoint. And so we've seen a consolidation of that. And where we have the most success with some of our clients are being able to offer a broad array of things. Because as we talked about a little bit earlier, sometimes the relative value changes in markets. And if you have flexible mandates to be able to move back and forth between those, you can ultimately provide more alpha to your clients. But I think from an ease of use standpoint, they're also looking at it and saying, if I have 50 managers doing 30 things, is there a way to shrink that down for their operational complexity?
And when it comes to your own M&A strategy, again, going back to the word you used, acquisitive, that you're acquisitive in this environment, what necessarily would you be looking for? Would it be adding capabilities, maybe areas where you do have white space? Would it be about adding talent? You know, there's specific PMs or et cetera you want to bring on. What sort of the thinking there?
Yeah, great question. So we look at it in a number of ways. There's the kind of the adjacent or tangential strategies that we do, and we've tried to build our business on a global basis. And so two of the acquisitions that were referenced before were really expanding capabilities in the Asia-Pac region. So we had capabilities on the securitized side as well as on the real estate equity side in Europe and in EMEA. We wanted to build that out in Asia-Pac, so we made some what I would consider tangential or geographic expansions. And then there's other areas we'll be looking just to bring in where we have white space, to your point. We want to make sure that our holistic portfolio is there to meet the demands of clients over time.
All right, Mike, keep in touch, especially as some of these deals do come down. That is Mike Freno. He is the chairman and the CEO of Barings. And it's going to be interesting to see, you know, if he's alone in that or whether or not we do see some more deal making when it comes to asset management.
Yeah, and that seems to be kind of the theme here. We talk about this idea of the maturity of the alternative asset industry, whether you're talking about private credit or private equity. And now, I mean, whatever the heck VC has become. Does VC still exist?
I think so.
Or is that just now private equity?
I hear it thrown around in there. But
I like to tease those VC guys. Yeah, they're a little sensitive. But it gets to the idea, too, of, you know, how that scale does work. And we talk about we're going to get into his partnerships, but obviously, you know, Mubadala's name is everywhere these days. And, of course, you know, the mashups, of course, with the insurance companies as well. We saw that with Nippon and TCW, Mass Mutual, and Barings, and quite a few other partners.
And we were talking with the State Street CEO yesterday about their partnership strategy. Certainly a popular avenue to pursue. But coming up next, we're going to talk about deal making in general with Christina Minnis. She is head of credit and asset finance over at Goldman Sachs as our live coverage from Milken continues. This is The Close on Bloomberg. Well, our next guest has been at Goldman Sachs for nearly 3 decades, now serving as the firm's global head of alternatives origination group.
You have to say that, 3 decades.
You know, the producers told me to, and I listened to them. Christina Minnis, great to see you.
Great to see you too, Katie and Romaine.
So I feel like we have to start with AI. You know, we were chatting in the commercial break about the AI build out, and you were comparing it to the railroads, and it only feels like, you know, a slight exaggeration when you think about the force this has been when it comes to both the private and the public markets.
Yeah, it's really exciting if you step back and think of the numbers, which are kind of extraordinary. There's a number being thrown at $100 trillion of investment needs to go in the next, you know, by 2040. And you think about that evolution and that amount of capital going to support growth and innovation. It's super exciting. And you could start with thinking that are the capital markets deep enough to support that kind of capital? And the great news is, yes, everyone is backing this, and you're seeing it in the private markets, the public markets, the equity markets, the debt markets, and there's a lot of innovation as well, which we're really excited about. And when we created the Capital Solutions Group about a year and a little bit ago, we were really thinking about just this type of opportunity, which is pulling together our asset-backed financing, our credit finance, our best risk management, and our corporate client relationships to really solve problems, both for our clients on the issuing side, but importantly on the investing side. These are majorly interesting investment opportunities for our own asset and wealth management division, but also for our clients. So it's a really exciting time, and there's a lot of consternation about it. But I think we at Goldman Sachs fundamentally are just really excited.
Yeah, absolutely. And, you know, another comparison I've seen is when it comes to this AI data center build out in particular is comparing it to the fiber build out. And I do wonder, you know, how you approach the question of whether or not there could be a risk of overbuilding here.
I think in any disruptive technology, there's always a risk of fervor. But what we see, again, if you just take a look at what needs to be built to support these models and to support this innovation, you know, I don't think we see it. But, you know, we keep an eye on it. And I know there were some articles written about bank exposure to the asset class. I know we at the firm are very comfortable with our exposure, but we obviously keep an eye on it, for sure.
I mean, you talked about whether the capital markets are deep enough to kind of fund this AI and technology build out, but kind of building off of Katie's question, are they smart enough? Because, I mean, there's a lot of money flowing around already. And I am curious if you think it's being put to the best use.
Well, I think when you look at the structures that people are focused on, first of all, we take it look at just investment grade. It's a very liquid, deep market. It's a rated market. It's very well understood. When we look at the amount of capital that's come into the asset class, we'll call it AI writ large. Year to date, it's about $500 billion. That's private and public. It was $450 billion for the entire 2025. Private credit also does deep diligence. And so if you look at the time that goes in to structuring these transactions, it is months and months. And there's a lot of negotiation around the leases, the real estate, the power. And so what we've seen is, people are being very, very diligent. There's an interesting transaction that we did at the end of last year for one of the fastest growing energy companies. And they came to us and said, look, we've been in the private credit market and we're interested in more innovation and potentially more flexible capital. What can you do? And we came up with a $5 billion package that went into what I'll call the classic markets, asset-based loans and high yield. They're back into us now, looking at preferred. And again, we're doing deep diligence with these companies before we bring it to market.
What about the duration mismatch for some of these deals? The idea that the technology is moving so fast so that, we're talking more on the debt side. So if you're issuing debt with obviously a fixed time frame on it, but the technology, let's just say, accelerates and shifts a lot faster than that longer term duration. Is that a concern or is that just in my head?
Well, I think if you think about from a data center perspective, I haven't read anything that would suggest we don't need data centers, right? And we don't need the technology of that infrastructure to support these models. I think the software and the language models are changing rapidly, but I don't think the infrastructure that underlies that, and importantly, the power required, is going to change. And a lot of this investment is going into the data centers and the power and the compute.
All right, Christina, unfortunately, we have to leave it there. Never enough time. That is Christina Minnis.
You don't want to ask her the next shoe to drop in private credit?
I mean, I do, but we're going to have to save it. We're going to have you back.
I just love the fact you said I've been working for 33 decades.
Well, I'm going to read your full title now. You are the head of credit and asset finance at Goldman Sachs.
You started very young.
Right.
Thank you, guys.
Christina, it's great to see you.
Great to see you, too.
We do want to switch gears a little bit and check in on shares of Pfizer because they did report a first quarter sales number that beat expectations. And Bloomberg's very own David Weston got a chance to speak with the CEO of Pfizer, Albert Bourla, on the back of those results. Let's listen to part of that conversation.
We announced that we want to have 8 significant readouts. And so far we had 3 or 4 of them already occurring. And we announced that we are going to start 20 clinical trials, and we are monitoring when each one of them starts. The same is with our commercial operations. We are monitoring how we are doing in terms of market share, how we are doing in terms of revenues, and the same is on our margins. We are deploying AI in ways that allows us to improve our productivity, dramatically actually, and that allows us to increase margins.
Tell us about AI, because we hear about that a fair amount in pharmaceuticals and specifically at Pfizer. Can you give us any specific examples where it really moved you forward faster?
Absolutely. We were reviewing with our board the first molecule that we were able to completely design through AI just 2 weeks ago. And 3 months ago, we wouldn't be able to do it. And 3 months later, we have already a molecule already designed, right, in the phase. But also, I want to say that when it speaks about AI, there are 2 different areas. One, it is what technology can do now and cannot do everything, but clearly can do much more than we are using it to. And the bottleneck for something like that is not technological limitations. It is organizational ability to transform itself into an AI-native organization.
That is Albert Bourla there, the CEO of Pfizer, speaking with David Weston, fresh off the company's most recent quarterly earnings report. Now we turn back to our coverage here on the ground from the Milken Conference in Beverly Hills. And, well, let's bring in a local. We'd like to talk to the locals here.
Why not?
He is the new president of one of the world's top private research universities, the University of Southern California. Beong-Soo Kim is the 13th president of USC, and he joins us right now with a big announcement, a big donation, $200 million from NVIDIA board member, and a big focus, and I don't know if it's a refocus or just a deeper focus on AI.
So, first of all, so incredibly grateful to Mark and Mary Stevens for their generosity and for their vision. And it's not a new initiative, but it is a deepening commitment to using AI to advance societal good. It's that simple. This gift is going to allow us to attract world-class AI talent who are working at the intersection of AI and the health sciences, security, business, and the arts. So we're incredibly excited. AI raises a lot of challenges and difficult problems for us to deal with as a society, but it also presents so much opportunity for societal good and for enhancing human lives, and that's what this gift is all about.
Well, let's talk about those opportunities, because, I mean, we're Bloomberg, so usually when we talk about the opportunities, it's like how it's going to help, asset managers and the finance world, but obviously AI is much broader than that in terms of its potential applicability. So in the context of a university, where do you see that research and the potential that comes out of that research? Where do you think most we should be looking?
What's so amazing is that you're seeing the potential impact across the board in every field. We have 23 schools, and every single one of those schools is seeing and trying to embrace the opportunity that AI has in terms of accelerating research and also assisting teaching and education. If there was one area where I'm maybe most excited, it's in the health sciences area. Thanks to developments in genomic understanding and technology, we've gotten a huge amount of data around how the human body and processes work at a cellular level. AI has been such a game changer in allowing us to process and analyze that data and take from it what we need to really completely switch the paradigm away from simply treating an illness to predicting who's going to get ill, when, and how to intervene at an earlier stage. So thanks to AI, we are really hopeful that we are going to be able to solve some of the most terrible diseases, Alzheimer's, blindness, heart disease, in the next decade. And it's an incredible opportunity that our researchers, not just from the medical school, but working in collaboration with engineers and with mathematicians and public policy experts and lawyers and cinematographers to attack these incredibly terrible diseases that impact so many of the people that we love.
It's a great point. I spend a lot of time talking to pharma executives, and they say exactly that. You think about AI's potential when it comes to drug development and sort of treatment discovery, and there's a lot of big hopes there. But I want to talk a little bit more about this specific gift, because you see a package of this size, and the natural question is, how did it come together? I mean, talk to us a little bit about, the time it took to negotiate, if you want to call it that, or just, how it all actually happened.
I will share with you that this gift came together very naturally. Mark Stevens is one of the most legendary venture capitalists in Silicon Valley. He has an unsurpassed track record of seeing companies and their potential and organizations and their potential before others. And the fact that he would want to make this investment in USC is such an incredibly important sign of confidence in our future and in the future of higher education. Mark was an early investor in NVIDIA when he was a Sequoia, and he continues to be on the NVIDIA board. And when we started talking about how he could have an impact, this all came together very naturally. We're in a race for talent, universities, the private sector, and most of this gift is going to be used to attract that world-class talent to USC.
Are your students ready for this, though, for this world that they're about to enter into?
Well, it's interesting. Actually, the students know more about AI than many of the professors. And at the same time, they're actually anxious and concerned about issues of academic integrity, the way that it's impacting critical thinking and classroom dynamics. So it's actually very gratifying that USC students are really leaning in and want to be part of the conversation and part of the solution. We put together a whole AI strategy committee last semester, and it just developed some recommendations. And we wanted to be sure to include student voices in that work, because they understand this technology and the way it could impact their futures at a very deep level.
All right, well, that is a good place to leave it. Really appreciate you taking the time to speak to us about this gift. That is Beong-Soo Kim. He is the president of the University of Southern California. And yeah, there you go. Let's take a look at these markets. Of course, we were getting closer.
Did they ever play Haverford in football?
No, you know, Haverford doesn't quite have a football team. Or I don't think we have enough people to field such a.
But you have
such
good
an
academics,
effort.
so that's what matters, right?
Theoretically, I mean, I ended up here, and I'm telling you about this record high that we're seeing on the S&P 500.
You are like the second most famous alumni.
Well, maybe third. We have Howard Lutnick, we have Alex Karp, and then we have Katie Greifeld.
Yeah, and we're we talk about a refocus here on the market. What people are investing in. We've seen obviously a big push. We was just talking about that gift from kind of tied to AI, NVIDIA, and that's been all the talk. We're going to get some more news after the bell in that space, including AMD, and maybe that pushes the market even higher. Yeah, definitely looking forward to that. Well, as we count down to those closing bells, let's turn to our next guest. He's responsible for managing roughly $2.7 trillion in assets. His name is Rick Rieder. He is BlackRock's Chief Investment Officer of Global Fixed Income, also the head of the firm's global allocation team. He joins us now. Rick, it's great to see you in LA.
Thanks. Great being here.
Let's talk a little bit about this disconnect that seems to be forming that we've been talking about when it comes to the equity markets and the fixed income markets, because you take a look at equities in a vacuum and it looks awesome. The S&P 500 at record highs. We had a 10% gain in April alone. And then you take a look at the Treasury market and the oil markets, and it's a little bit of a different story. There's a little bit more concern here. And I just wonder, how we sort of see this come back together, whether or not that disconnect can persist and maybe get exacerbated.
So maybe I'll start from the technical point of view. The difference in the technicals in the equity market and the bond market are as diverse as you can imagine, in that we don't create enough stocks. The buyback relative to the issuance of equities, people talk about the IPO market, it's tiny relative to the buyback market. We don't create enough equities, and there's a huge amount of cash out there. So you just get this continued buying, and then there's no stock. Now, if you have a bad piece of news, it can trend down for a day, a week. In bonds, we're getting $520 billion a week of gross supply of treasuries. There's no dearth of supply, so you have that is distinctly different. The other is we're witnessing a growth paradigm that is unbelievable. That is, I think this year you could grow 6% nominal GDP after a number of years of significantly positive nominal growth. And then you see this in the earnings numbers that are coming out. I've been pretty blown away by not just that you have top-line revenue that's impressive, but you have pricing power. Pricing power is the worst thing you can have for the bond market, because obviously what it means from inflation side. So I think it can persist. We think about portfolio allocation, and we've gone through this. You still have a lot of danger out there in terms of geopolitical risk. But if you said, what's my convexity of upside, downside, if you know you're going to have either good news or bad news, and they're going to correlate together oftentimes, right? Like equities have a whole lot more upside than quite frankly, interest rates do today.
Yeah. We'll bring this conversation to the corporate credit market because, the point has been made that spreads, you've seen a little bit of widening, but, a pessimist might say that looks complacent. But when it comes to the strength that we're still seeing through in corporate earnings, when it comes to equities, I have to imagine that translates to the performance of the credits as well.
So, it's pretty hard, and people say, I don't like these spreads at these levels. That being said, the yield fits portfolios, not just our portfolios, but with your pension fund, life insurance company, any insurance company, et cetera. The yields are very attractive because the risk-free rate is high because the central banks are keeping it there for inflation. So those yields are interesting. It keeps demand at a pretty at a great pace. The other thing that I think is significant is when you have, people talk about could you have defaults? People talk about private credit. There's stress in private credit. When the economy's growing at 6% nominal, or let's say I'm wrong and it grows at low to mid fives, it's pretty hard to have a default cycle of any significance. I've learned over my career, cash flow makes up for a lot of mistakes. And as long as you have that sort of backbone of cash flow growth, you're not going to have any significant default cycle.
I am curious, though, when we start talking about 5, even 6% nominal growth, where is that growth coming from? I know there's been a lot of discussion about kind of the accelerant that we've seen from AI and the technological spending. Is that it? Is that the engine?
Part of why I've been pretty adamant about this. You have a lot of the U.S. economy; it's actually in recession. Yeah. And part of why I've been a believer that even if you grow this fast, Fed can cut rates. The reason why I think they can is because what is rate sensitive in the economy today is actually in recession. So you think about traditional manufacturing, you think about housing, you think about where young people, low income people that are struggling, and that's where the interest rate tool is effective. But then you have two parts of the engine that are steaming ahead. You've got obviously AI, and that number is so big, certainly on a short-term basis, it's huge. And then you've got consumption that's coming from the higher income cohort generally that's keeping it up. So you've got an economy that's doing extremely well on two engines. And then, by the way, for a lot of people in the country, it's actually not going so well. And so that's part of why, and your question about the interest rate tool and how to think about it. I think you'll see a Fed that will cut rates because of that part that's struggling.
Well, I'm curious because this gets to the whole philosophical debate about monetary policy, and obviously you were rumored to be in the running for the Fed chair. But I mean, Kevin Warsh is coming in. He clearly has, at least if you take him at his word, is going to approach monetary policy in a much different way philosophically. And I asked this question to Alan Schwartz over at Guggenheim earlier about this idea of the market also needing to change itself philosophically if we are indeed going to start looking at the economy and monetary policy in a different way.
That is a long discussion, and quite frankly, I think one of the most interesting discussions we have in the world today. I think we're seeing part of the derivative impact of this AI, the technology boom, is we're going to see a productivity revolution that nobody's ever seen before. I mean, how many companies, including yesterday, are announcing growth, CapEx spend, and we don't need as many people? Part of why I'm not that worked up about inflation over the intermediate term. Certainly over the near term, we've got a transmission from a variety of things, fuel being the number one. But I think productivity and employment are going to change, and I worry about, and I've not heard anybody give me a good reason why in the short term the transition in terms of employment is not a difficult one. The one thing that I think will be different in terms of Fed perspective, I think you have to be more prospective about where the puck is going. Versus where we've been historic, and the historic analogs don't really work in what is a new era.
But I'm curious on that transition, in terms of the labor market. Do you think that will be a short transition? Because that matters. I mean, if we're talking about a prolonged displacement of folks for years, that's obviously a much bigger issue. But if we're talking about something that's a little more truncated, is that something that everyone can live with?
So, listen, I think the transition, I think we're talking about, it's certainly a couple of years. I mean, it's pretty hard to project how the world changes, industries that grow relative to this. But for the next couple of years, some big industries, I always talk about driving and some others that employ a lot of people, that transition, that retraining is going to be, and the size that it's happening and the speed it's happening at will be dislocating, certainly for a couple of years. By the way, I would argue at the same time, we have a debt burden in the country that is compounding higher. So, anyway, these are some of the things that I think, and I think this Fed will do a great job. But I think the key is going to be, are they prospective about where we're going and about what the new challenges are versus the analogs from history that aren't as relevant?
Well, we want to also talk about whether or not the market is ready for the idea that maybe we're going to get less communication from the Fed. We know that, the idea of maybe not having a press conference at every meeting has been floated. And you also have a Fed makeup that looks like there's going to be more dissents coming forward. I think you think about the last Fed meeting, 4 dissents. We certainly haven't seen that for a couple of decades. So, I mean, what does that potential adjustment period look like if you are getting less communication from the Fed and you are seeing dissents on the rise?
The Fed's objective is to create full employment and price stability. It's not to make sure the markets feel good about what you're doing at every meeting. And I actually think having a lower level of forward guidance, particularly when you're easing, to tell the world like we may go 25 every 6 weeks, I don't think is actually that robust. If you kept your cards to your vest and said, okay, now I got to shock the system because I'm trying to execute change. I'm trying to get financial velocity moving. I actually think lower, and do the markets feel like, gosh, it's a little bit more uncertain, and do you increase volatility and so on? Maybe at the margin, but as long as you're effective on communication as to the metrics you're looking at, this is what we're pivoting off of, so the markets understand, okay, I understand what the reaction function is going to be. I don't think you have to be that explicit. So anyway, I think it's super healthy to pare that back a bit.
Yeah, and it'll be interesting to see what that weaning process looks like. But in your view, a healthy one there. I do want to talk about how the shape of the yield curve might change going forward. We were having a great discussion with Ann Walsh of Guggenheim yesterday, and she actually made the case that you could see a flattening come through. The steepener has been breaking hearts for years now, and the logic made sense. If you had a cutting cycle come come through that would lower the short end. Maybe you'd see the long end rise. But she was talking about the issuance that she's expecting. Maybe you could actually see more of a flattening impulse come through. And I wonder where you land.
You know, listen, we run the CTFCO Bank, as you know.
I've heard about it.
Yes, no, you've been very kind to mention. And so, listen, I'm part of what has been effective heretofore is to say, gosh, the long end of the yield curve, interesting. I'm getting my long-durated assets through equities, or a lot of people are doing that. In my other portfolios, we're doing a ton of that. And say, gosh, I don't need the thrill of the back end of the curve moving around. Yeah, so I'd rather stay in the front of the belly of the yield curve. So that's part of why you've created this natural steepening tendency, because you get enough yield when you diversify in terms of different assets. I will say, people don't realize that 89% of the Treasury's debt's in the 0 to 2 year part of the curve. We don't actually have that much debt when you take what's net of the Fed's balance sheet. So the reason why people get in the steepener trades, and I actually think fundamentally the curve could steepen, the technicals are actually keep that from happening. So listen, I think if you said to me, where are we going in 6 months, a year from now, we have to get the mortgage rate down in this country. And do I think the back end can stay contained? I think so. My view is like putting on steepeners and flatteners, hard to make money on that, to your point. But listen, I think the 10-year is going to get down to 4%.
Okay.
But I think it's going to take a little bit of time.
Can I just say, when you're ready to really step out the yield curve and go long duration, will you tell us? Because we've been talking for years, and you've been in the belly for a long time here.
Yeah. So now maybe if we get on and we can talk about on the show. But no, I mean we're and by the way, there's no, like everybody says, it's this yield that I'll jump in. I actually don't think. I think what will be the catalyzing influence is when you start to see real motivation around the mortgage rate coming down. And by the way, I think there's some fiscal initiatives that can bring rate down and mortgage rates down. But once you start to see that, then I think it's going to be, then it's a place where we would start to go out the yield curve. I will say, we run optimizers on our portfolios. These real rates out the curve are pretty attractive. I just think today, you've got some inflation coursing its way through the system. You've got an alternative asset, i.e. equities, that's a better long-durated asset. But my sense is that we'll get a chance over the next few months to start to go out the curve more aggressively.
All right, well, keep in touch. It's always great to see you. That is Rick Rieder. He is Chief Investment Officer of Global Fixed Income over at BlackRock. Just a great, wide-ranging conversation, especially when it comes to, what we're seeing in the differing psychology between equity investors, the technicals in that market versus fixed income. Yeah, I thought that first point that he made, talking about that dispersion, was important. You see yields slightly lower here on the day. He says, okay, over time, we maybe get down to 4. We're about a 4 spot to 4.2 on the 10-year yield. I do just want to point out, as we move closer to the closing bells, we're off the highs of the day here. But I was just taking a look at the big movers. I mean, it's a lot of names in the chip space. Right. Your Broadcoms, your Intels. You're going to get AMD earnings after the bell tonight. Supermicro as well. Yeah, in addition to, a check on the crypto landscape when it comes to strategy, but certainly chips have been the conversation in this market, so it'll be fascinating to see what AMD has lined up for us. But as we await, let's bring in Dana Settles. She is co-founder and managing partner at venture capital firm Greycroft. Active investments include companies such as Goop and notable exits. Yeah, I kind of do. They opened up a Goop kitchen in New York. Actually, I was on Grubhub the other night looking for dinner, and there was the Goop kitchen there. I didn't order from it, but maybe I should have. Anyway, notable exits include Bumble and the real Dana. It's great to see you.
Great to see you too. Thanks for having me.
So let's talk a little bit about how you're evaluating this landscape. When you take a look at your potential investment opportunities right now, how is AI sort of being applied as a lens here?
Yeah, well, it's interesting you mentioned Goop Kitchen, because one of the things that we're really focused on actually is AI in the physical world. We think that's the next major wave.
I did a panel on that this morning, by the way.
I'm sorry, I missed it.
It was great. Fantastic.
But no, we do think that that's a huge opportunity and, applied to all kinds of areas. Yeah.
Well, tell us what that means, especially as it applies to Goop Kitchen, which maybe I actually should order from. I've been going to Sweet Green, but
you got to try Goop Kitchen.
Maybe tonight.
Yeah. Well, look, I mean, it's robotics is a big area for physical AI. And, if you think about, I don't think that right now necessarily the cloud kitchens are using a lot of robotics, but that's a big opportunity down the road. And so things like that, where you can actually start to deploy, and we have an investment in a really interesting company called Applied Intuition, which is essentially, think about it as the brains that goes sort of inside of a lot of robotics and mobility. They're today working with most of the major auto manufacturers and increasingly in defense and robotics, et cetera.
Well, I am curious about that, too. I mean, we talk about AI in the physical world, and we've seen that broaden out, not only in terms of the companies, but also, more importantly, the investment dollars. I mean, and you restructured the firm around AI a couple of years ago, if I remember correctly, or 2 or 3 years ago. It's going well, I assume.
It's going great,
So, but what is the opportunity there? Because, I mean, we're way past just, the picks and shovels or whatever euphemism we were using a couple of years ago.
Well, I mean, I personally, I think we're still in very early days, even in terms of the picks and shovels. I mean, I think, we'll continue to see wave upon wave of innovation, and that's
when I hear people say picks and shovels, that almost sounds like they're not committed to the long-term structural trend. It's like, oh, we're just going to, make money off the people trying to make money off this. You're deeper in that.
We're definitely looking to make money off of the long-term, trends. And but when I say picks and shovels, I mean, look, I think that the models that we have to date in LLMs are really, really exciting and interesting. And a lot of the things that have been, sort of disrupted or innovated are a lot of the things that we all do, frankly. I mean, a lot of white-collar jobs, a lot of. But when you look at the future and, sort of the majority of GDP, I mean, it really is in the physical world. And that's where you see things like world models, Jan LeCun's company, AMI Labs, which I think, sorry, I feel like you're about to ask me something.
Well, sorry. I got Goop on my mind. I was going to bring this back to Goop, but I swear, this is a legitimate question. Because, I mean, you have a big consumer focus. I have Goop and Acorn and Thrive, and I'm probably forgetting a couple of others here.
Absolutely.
But this is all done through the lens of technology and AI, right?
Yeah. I mean, the way that we think about it is really technology exists in service of the physical world, ultimately. I mean, if you think about anything that is touched by technology, because it's something as a product or service that ultimately is delivered to humans.
And I am curious. I mean, when you're going through your due diligence, we know that AI is developing so quickly, and it's this lens in which you're viewing these investments. You're interested in how AI interacts with the physical world, but even still, I mean, how do you sort of develop conviction that this is something that's still going to be relevant in 2-3 years' times? Because you think about the SaaS apocalypse that's happening right now in private credit, I have to imagine a version of that could be applied across industries.
Yeah, look, I mean, it is a disruptive time, and I think we look to back founders who are, have a very, very big vision and who are able to execute against that. So very strong technically, strong research backgrounds, ability to continue to attract talent, both on the research side and on the commercial side. Because if there's one thing that's certain, that things are going to change. And so I think you have to be able to adapt. You have to have a broad aperture. But, I mean, when we think about, companies that are really impacting the real world today, and when I talk about technology in service of people. I think the healthcare area is a really interesting area, and one where there have been real breakthroughs, and not just breakthroughs, but also just like it's needed. There's such a shortage of doctors and nurses, and so that's where AI models have really come into use in the mainstream. I mean, clinical use. And so I think that that's an area that there's, you really do see, I think last year, over 100 million Americans were served in the clinic, where actually clinical decisions were made by Open Evidence, which is a company that is in the, clinical decision-making area. And I mean, that's now here to stay. That's not going to go away. Sorry, circling back to your question about what's here to stay. Yeah.
All right, let's quickly check in on the closing bells here. You can see the S&P 500 finishing at those all-time highs, remain higher by about 0.8%, and we are awaiting those AMD earnings as well.
Yes, we certainly are here. We talk about the moves higher in this market in spite of everything that has gone on, and we go talk about this idea of how the earnings picture has sort of held up within all of this. We're still in conversation right now with Dana Settle, co-founder and managing partner over at Greycroft. And one thing, Dana, that I am curious about too is, we're in LA. You famously moved from the Bay Area to LA, it was like 20 years ago. But you recently reopened an office in the Bay Area.
We did.
And I am curious about sort of the center of gravity when it comes to AI and just all the sort of technological advancements here. Yeah. Is this a sign that maybe that pendulum is moving back towards Silicon Valley, or is this more just a sharing of the wealth?
No, I think it's. I mean, when you're sort of in early days of a technological cycle. I mean, when I started out in venture in sort of the mid '90s, it was we were investing in silicon, we were investing in semiconductors and networking equipment, all the things to build the internet. Today, a lot of the early innovation happening in AI is happening in Silicon Valley. And so that's why we decided to open an office there and really build a team over the last few years. But that innovation is actually will enable things everywhere. I mean, there's a flourishing, business in Los Angeles around defense, aerospace, robotics, et cetera. And
you're invested in a couple of those, right?
We are. We're continuing to invest in that area because, again, these are things that are being fundamentally changed and enabled by AI. And so we just think that it creates a huge amount of opportunity in the same way that, the internet changed a lot of things in the, mid 90s and early 2000s. Similarly, AI is really changing all industries today.
All right, Dana, great to get some time with you. That is Dana Settle. She is co-founder and managing partner over at Greycroft. Really interesting conversation there, especially when it comes to, more the private side and how, you think about AI's impact. It's not just the chip makers, even though we think about the fantastic April that we saw for the Philadelphia Semiconductor Index. It's having ripple effects across industries here, and certainly when it comes to the physical world as well. Meanwhile, you take a look at these markets. As we closed up on the day, as we're awaiting these AMD earnings, and you can see we finished at all-time highs when it comes to the S&P 500, and it was the tech sector where we saw a lot of strength with the NASDAQ 100 higher by about 1.3%. Resilient, probably helps that crude fell a little bit.
Yeah, and as we await sort of these earnings, I mean, obviously we want to hear from what AMD has to say. We want to hear Supermicro to a certain extent. That's a little bit of a different story here. But now, of course, we talk about this idea of kind of whatever cycle that we're in. But we want to talk about AI, I mean, kind of across the platform. We've talked a lot about it from a business perspective. We talked about it from AI in the physical world here. We also want to talk about it a little bit more conceptually. And we want to bring into this conversation right now Will.I.Am. He's one of the more credible celebrity to tech crossover stories out there. Of course, he's the founder and CEO of FYI.AI, 9-time Grammy winner, co-founder of the Black Eyed Peas, founding equity stakeholder in Beats Electronics. He's an investor in Anthropic and OpenAI and NVIDIA. And I think you just taught a college course over at ASU. Yes. You help students sort of create their own agents. Will.I.Am, welcome to the program.
Oh, thank you for having me. It's good to see you guys here.
Talk about this. I mean, we talk a lot about this idea of preparing the younger generation for this world they're going to come into, which is going to be a lot different from the world our generation came into with regards to technology and AI. I mean, what were you talking to those kids about?
So the students come into our class that I created, the course I created called The Agentic Self. They come in with zero, they leave with the Agentic Hero. We guide them through ethics, pointing out some of the tripwires that happen during social media, reminding them that they have to be ethical, they're accountable for the agent that they're going to be deploying out there into society. And some of the students, the things that they've turned in for their final, it's a 16-week accredited course. Amazing companies by pointing out solutions to problems. Pointing out problems and creating solutions to that problem. A woman by the name of Claudia, a company called Aki, amazing solution to vendors in the global south that aren't connected to the internet, don't have the knowledge of building agents. Going there, giving them personal agents that they can build, and that agent being accessible on a phone call.
Yeah.
So
with this idea, when we talk about agents, I mean, it scares a lot of people. Some people say, oh, agent, that just means somebody's going to take my job or something like that. Now, you've done a lot to sort of not only educate people about this, but I even saw a product that you had, a teddy bear. Was it Mofo teddy bear?
Yes.
Okay, all right. But this is AI within that, basically an agent, agentic AI in that. Was the idea to kind of make this a little bit, I mean, I guess teddy bear isn't human, but for lack of a better word, to humanize this a little bit more, or what?
No, it's just it's a fusion of creativity and technology. So the Mofo is not a toy. So on the box it says, I am not a toy.
Yeah.
It's a tool to get work done. in the form of something that's expressive that you could communicate with. We have our text-to-expression architecture, so we know what text-to-speech is, we know what ASR is, we know what LLMs are. We have this text-to-expression, so the agent's able to express itself and give you cues on your digital world where not everything should be verbalized.
Right.
You know?
Yeah.
You knew. So there's other cues that you can do that are outside of an emoji that you have to type in text.
Yeah.
So it allows the agent to express itself for things that you are going to deem with you and that device personal to you. But more importantly, it's an amazing art project.
Yeah.
Creativity at its highest form.
I do want to talk a little bit about FYI.AI. And first of all, let me say some of the investments you've made, a lot of investors would like to have that portfolio. But when it comes to what you've created there, what is sort of the mission statement? What are you trying to accomplish with FYI.AI?
So two. I started my philanthropic endeavors in 2008 with my I Am Angel Foundation, telling kids in the inner cities that they should apply themselves in this conversation around, job creation, career creation, and industry designing. Like, use your imagination to its full potential. But when you tell a kid from the inner city to take a science, technology, engineering, and mathematics course, and you're not doing that yourself, how can you expect them to take you seriously? So I started FYI.AI to show them, like, hey, if I can do it, you can do it. One of the things that we wanted to solve is how people communicate and get work done on a messenger. To work on a messenger, you need 5 different products. To work on WhatsApp, you need Dropbox, you need WeTransfer, you need zip files, you need all these types of things. So on FYI.AI, you could send gig size files on the messenger. Each person, I don't like using the word user, is granted an encryption key. So to ensure that your data and your privacy is all locked under a key that you own, that you keep. Your data is yours. Then we started building personal agents. This is our personal agent tool, so you can create and build your agent that reflects your beliefs, your concerns, your point of view, and your aspirations and where you want to go in life. So your agent knows you. And we're about to show how our system integrates with other legacy systems in the next couple of weeks.
All right. Well, really appreciate you coming on here to talk about this. Really fascinating, looking at it more from the creative perspective with Will.I.Am, of course, the legendary musician, founder, and CEO of FYI.AI. Now, we do need to get some earnings that just crossed the wire a little bit while ago. We are still awaiting to hear from AMD. Yes. But we did hear from Supermicro, which, of course, was at the epicenter of the data center build-out. And we talk about this idea of whether they've finally gotten their mojo back. The company actually providing a pretty wide range for their net sales forecast for the current fiscal quarter, their fourth quarter, $11 billion to $12.5 billion. Now, the low end of that range is below the average of street estimates, which was coming in at about $11.2 billion. Now, for the most recent quarter, it does look like overall their numbers were relatively in line with estimates, Katie Greifeld. But it gets to the idea here, as investors sort of look for where to find those opportunities in that data center build out. Is Supermicro still a part of that story?
Yeah, absolutely. You can see, at least for right now, maybe the question or the answer is yes. Shares higher by about 9% or so. And I mean, you mentioned that fourth quarter net sales range, maybe the low end below estimates, but certainly the midpoint of that range higher than estimates. That's being rewarded in the after hours right now.
All right. We are going to keep an eye here on those earnings and the movements after hours, still awaiting earnings out of Advanced Micro Devices. But we do want to get back to what's been going on in asset management, particularly in the world of private credit. And no one is better to talk to get a read of the health of the credit markets than Victor Khosla. He's the founder of Strategic Value Partners. And over the course of his career, he's turned a pure distressed investment shop into a platform spanning private equity, special situations, real estate, infrastructure, aircraft, power plants. Oh. And today, and this is what I like, he got operating control of at least 18 businesses out there employing roughly 100,000 people. 22, not to shortchange you. But that gives you a much different perspective. I mean, it's one thing to just to sort of put your money in and hope for that return. It's another thing to actually be an operator itself here. What is the health right now that you're seeing in the credit space?
Lots of pressure. You know, the way, and Romain, we talked about this last year at this conference. Last 2024, 2025, pressure is being amped up, high interest rates. People can't make them, default cycle picks up. over the last 4 months, last 5 months, you have an oil shock reverberating through, unclear just how deep. And at the same point in time, software has accounted for 20% of high-yield portfolios. Software, the parts of software, existential today.
Is the software concern, to the extent that we've seen it play out in the media, is that appropriate? Because it seems like you'll hear from some companies saying, look, you know, we're probably a lot stickier than even with AI out there than we would be without it. I know there's some other software companies that just have awful business models, but they were probably going to go away anyway.
The software concern's really appropriate.
Okay.
And look, and by the way, there's nothing systemic about it.
Okay.
It's like, you know, the telecom bust in 2001, 25% of telecom companies defaulted. Oil and gas crash, 2014, 35% defaulted. So if there are 15, 20% defaults in software, it's concern, yes. Systemic, no. Systemic's a whole different thing.
So the concerns in software warranted at this point, in your view. I wonder if you see any opportunity in software, because whether those concerns are warranted or not, you have to imagine maybe there's some babies that have been thrown out with the bathwater.
Too early.
Too early.
Yeah. So, and I'll just give you our perspective. For the last 2 years, there have been busted software companies. We have looked at them. You know, we've had a team of people looking at them, studying them. We've hired technology and consultants and advisors to help us. And what we find is when software goes, it goes bad. It's not just a gentle decline. It goes off a cliff. The business model gets outdated. So when we look at this software cycle we're in, the software default cycle, we think it's going to take 9 months, 12 months to figure out which ones are really popping. And I think to our point of view, there's product out there, but we're just being very careful.
Yeah, I was wondering, I mean, what kind of stance do you take in that sort of environment? Should we see defaults really pick up when it comes to the software side? I mean, is that an environment where you can be offensive, or maybe one where you'd want to be a little bit more on the defensive?
You know, there's one thing you said, if I could perhaps correct. Yeah, please, humor me. Default rates in 2024 and 2025 are 6% a year. Those are Moody's default rates. 2 years back-to-back 6%. Those are big numbers. In COVID, it was 9% for 3 months, and then it was gone. So we come into this cycle today already with lots of headwinds, lots of pressure. So everything which the oil shock does, software reverberating does, it just compounds it. I think it's caution. Caution's merited. And by the way, the opportunities, please, in a good year, we'll invest $6-7 billion a year. We've got about $22 billion.
Well, let's talk about those.
We've invested $1.5 billion in the last 6 weeks.
In the last 6 weeks.
Don't annualize it.
Okay.
Don't annualize it, right?
I've already done it.
But it gives you a sense as to what's starting to come on off.
Well, then I am curious. I mean, you recently, what was it? Your special situations, your fifth fund on the special situation side. That is a pretty broad mandate.
It does.
So, give me a sense here as to in this world we're in right now, where you go after opportunities. I mean, is there a focus to it or what?
Oh, absolutely.
Yeah. Okay.
Right. So, software obviously is not a focus.
Okay. Yeah.
Right. What we find is the contagion caused by everything I said. So if you look at anything associated with home building or building products, it's in the tank. Chemical businesses, once in a 20-year down cycle. Consumer brands in trouble.
Okay.
Europe is about...
You put a lot of money into Europe.
We have. 30% of the overall high-yield market struggling economically. West Germany probably going into a recession. Real estate as an asset class, slow-moving tsunami over the last 2, 3, 4 years, picking up speed as we kind of go, right? So this is not, it's not pockets of opportunity. It is like large chunks of industry and businesses.
But you rattled off quite a few areas. But the idea you see that as opportunities seems to suggest you think the cycle that we're in is a cycle, that this is a down cycle and that these will rebound.
Yes.
Okay.
When we invest there, Roman, we look at it even a little, we add a little something.
Okay.
Sure, we think they'll rebound, but we think a lot of these businesses which get troubled, there's a lot of upside operationally by going in and fixing them. So when we are buying, we're not just buying for the rebound. We are saying this is an undermanaged business. Let's fix it. It's got a lot of upside. The rebound is just extra if and when it comes.
I do want to just talk a little bit about potential ripple effects here, because I'm taking a look at an interview you gave to some of our colleagues on the print side. When bring it back to software, you talked about how this software pain is going to taint everything across credit. And with that in mind, I mean, we just got through a first quarter where the redemption quests from some of these BDCs were really interesting to look at. And I wonder, you know, should this continue, would you expect to see more quarters of these types of levels of requests to pull money?
I think our sense, when you see this happen with these open-ended funds, it's not one and done. When people put in redemption requests and they can't be fully redeemed, it creates even more redemptions as you go. I think our sense would be 12 months, 18 months for this cycle to work through. So it's not over.
It's not over. Victor, it's really great to get some time with you. Would love to pick up this conversation again soon. That is Victor Khosla. He is founder and CIO over at SVP. And meanwhile, we did get those earnings from AMD, Romain. First quarter adjusted operating margin, 25%, as you can see there. First quarter adjusted EPS coming in at $1.37. The estimate had been for $1.28. And when it comes to the look ahead, some details here when it comes to second quarter revenue coming in, or rather the estimate coming in for between $10.9 billion to $11.5 billion. The estimate had been for $10.52 billion.
Yeah, we're still talking about a company. I mean, we're talking about 38% revenue growth, which for a company this size, I mean, I guess would be lauded under any circumstance here. There was some margin compression in the most recent quarter, though it might be part of the reason why you're not seeing more of a reaction to the upside. The company also saying that the engagement around that 450 and that Helios product, which of course is what everyone wants to know about, in their words, Katie, is strengthening.
Strengthening, absolutely. And certainly you can see shares strengthening after hours, really across the board. AMD now popping a little bit more. We're going to continue to keep an eye on that. But let's turn to our next guest. Purnima Puri has spent her career working at top firms across Wall Street. Specifically, she spent 5 years over at Goldman Sachs on both the credit arbitrage desk and in the principal investment area, currently over at HPS, where she is a founding partner and head of liquid credit. Great to see you.
Great to see you.
Let's talk about liquid credit because, you know, you think about private credit. We've spent a lot of time on it already. I want to talk about what you like in liquid credit because I know that higher quality, high yield bonds is on your list. Tell us why.
I think liquid credit, I guess a couple of things. One is that this has been it's a good income environment, and earnings have been strong, defaults have been low, and therefore spreads have been reasonably tight, I would say, in high yield. Spreads are a little wider in the loan market, but the ability to just generate income, if you can avoid mistakes, is meaningful right now in the liquid world, and so the high yield bond market is interesting. Base rates are higher, which also helps on a yield compounding basis. On the loan market, most of the weakness has been pretty isolated to software. Now, I will say software is software, and then it's IT services, and then it's professional services, so you could bucket it in a lot of different ways. But for the most part, I would say that the weakness in that loan market has been isolated to those sectors most in the line of fire for AI. However, some of that has rebounded now, and the loan market's up on the year. With and without software, you can slice up the index all different ways. So I think on the liquid side, sort of the power of compounding is good. The techno's really strong. We're coming off of years of very limited supply.
Yeah, and it's interesting because we have that conversation when it comes to the investment grade liquid market all the time about the fact that you do have the hyperscalers, all of this AI capex coming through, maybe pushing spreads up a little bit just because you have that big bomb of supply. But that doesn't sound like it's necessarily a factor when it comes to the supply dynamics, when it comes to high yield.
You know, you're starting to see it. There's been a lot of hyperscaler and AI-related debt financing in the investment grade market, but you're seeing it in the high yield market also. I mean, I think, you know, the numbers are sort of like 30 or 40 billion dollars year to date. The estimates are for up to 80 billion dollars. These numbers are moving very, very quickly. By the way, whatever the number was 3 weeks ago, it's not the same numbers this day. But let's use sort of circa 80 billion, and maybe it's a little less, 60 to 80, even if you could say. The gross issuance is expected to be around 400 billion. That's a big percentage of the high yield market.
Fair.
And this last week, we saw the first loan that was being financed as well. So I think there's so much financing need for AI-related CapEx, whether it be access through the investment grade market, it can be access through the private investment grade market, it can be access through the high yield market, the loan market. So I actually kind of disagree with that. I think that you're seeing that financing opportunity available in all markets.
I've asked this question of a lot of folks in this space, and this about duration and the idea of a potential duration mismatch. I mean, we know how fast AI and this technology is moving here. So how do you structure lending products? I mean, you know, if you're, you know, locking in at 10 years for effectively a data center or some sort of technological advancement that might be completely different in 2 or 5 years. How do you sort of approach that?
Yeah, so the way the data center financings have taken place thus far is that you either have a data center financing or you have a GPU financing. Okay. And so in both of those instances, because it's still early days, I mean, the first one was the Meta deal. I think it was done in October or something like that last year, right? Yeah. So, and that was $29 billion. Each of these has been reasonably bespoke, and what I mean by that is there's a range of terms on these deals. Some of them have 4-year rolling lease terms, and you can release. Some of them might have a guarantee from a parent company, so you can look to that guarantee. Some of them might have amortization. There's deals that we've seen that are 5-year amortizing to get to your question. So I think that every single one of these so far has been reasonably bespoke and been structured, and things like, to answer your question directly, you know, what is protective in terms of mismatches? Amortization is protective. Yeah. Releasing is protective. Residual value guarantees are protective. So there's a whole host of sort of ways to get around that.
I do just want to ask you a question about the business. HPS now under BlackRock, and I'm just wondering, you know, you sit along, you know, $3 trillion in public assets alongside your private credit book here. How does that work?
The sourcing funnel is super wide. It's just gotten so much wider. And so that's been a real asset to our business, I think, on the private side. So on the private side, just to remember, we have the direct lending business, we have a junior capital business, we have a private investment grade business. So being able to see all the things, we're able to see, the aperture is much wider. So that's number one. Two is that BlackRock is involved in so many stocks. And so oftentimes we're getting access to companies that we might not have had as easy access to, just in terms of diligence. And that's been super helpful. And then on the liquid side, the aperture widening has given us sort of a little more heft and scale, I would say, than we had before.
Okay. Purnima, great to catch up with you.
You too.
We can't let it go by too long. Purnima Puri, a founding partner and head of liquid credit over at HPS Investment Partners. And, you know, Katie, she mentioned that big Meta deal, $27, $28, $29 billion deal. Well, guess what? Coming up, we're actually going to talk to one of the guys who was part of that. Remember, that was the big PIMCO deal. That was their biggest ever here, and there are a lot of talk here that we're going to see deals even larger than that coming down the pike as we continue our coverage here in Beverly Hills. Yes, the Milken Conference. We're going to talk to the CEO of PIMCO, Manny Roman, when we come back after the break, right here on Bloomberg. PIMCO, the $2 trillion asset manager, has made a big push into the $20 trillion plus asset-backed financing market, with deals spanning digital infrastructure, auto loans, equipment-based lending, aircraft leasing, residential mortgages, just to name a few. And it just led that $27 billion debt package for Meta Platforms' data center that we were just talking about, Katie. The CEO of PIMCO, Emmanuel Roman, joins us now here at Milken. Great to see you, Manny.
Thank you for having me.
Let's talk about that data center deal. I mean, that was huge. I mean, it was your biggest, I believe. And there are a lot of people saying that the size of these deals that we're seeing, they're just going to get bigger.
So let's sort of look first at the macro picture. The macro picture is that there's an enormous amount of CapEx that needs to happen, and it needs to be funded. And there's different ways to fund it, but in the structure, you had Morgan Stanley being the lead bank, and then you had a pref equity, and then you had a lot of debt. And we found the debt to be incredibly attractive. and we flex our size to actually have a very good investment for our investors. We did the exact same thing last week with Oracle. It's in the press. And, you know, we don't know how many more of those there are, but they are quite attractive piece of paper. And, you know, they need to be structured. There's an insurance angle. There's, you know, a due diligence angle. You need to find the right pref equity, the right attachment point, and all of these things. But, you know, it's been very attractive.
Are you anticipating to see more deals of this size or larger?
We anticipate to see more of this. They may happen in different ways. You know, some of the Magnificent Seven don't need anyone to fund themselves, and so they may just go in the public market and issue debt, which is good for us, given the fact with PIMCO, and some of them may need more structured transaction. I think all works.
Deals of this size being one thing, but overall, I mean, what does your pipeline look like? What would you like it to look like when it comes to some of this data center financing, especially when it comes to asset-backed finance?
I think the honest answer is we look at the whole world and we try to decide what's attractive and what's not. And so we would compare any infrastructure deal to what else we can do in the world.
Right.
And so, you know, these two deals were incredibly attractive. We've done some others which are not public. And the next one, hopefully, will meet our criterion. But the world, all of a sudden, because of what's happening in Iran, there's a lot of attractive opportunity to invest. And you know, you need to sort of rank them and see where they fit. And, you know, we have different clients with different liquidity profile. And some of them are insurance company, and so they only can buy rated notes. And some others have different constraints.
Well, expand on that a little bit more, because, you know, you think about what's going on in the Middle East, the geopolitical tension that we've seen unfold over the past 2 months. We talk a lot about the risks, the disruptions, but expand a little bit on the opportunities that you do see for PIMCO potentially here.
So I'll give you a snapshot. We have a very successful emerging market business. I hate the word emerging market. When you mention emerging market, I think of France, but it doesn't really apply in this case. We have very good relationship with the various issuers in the Middle East. As you know, they all have high rating, and the FT reported that we had been quite involved in terms of lending money to them. But, you know, you're dealing with AA or AAA issuers who need money and decide to tap the capital market very quickly. And then we either do a very quick one-off transaction, or we anchor a transaction where some other people come. And, you know, they were very attractive to us. And once again, you know, it's a very important footprint of what we do.
I am curious, too, particularly with some of these larger debt deals. I mean, are you going to take a much bigger role in distributing some of the debt that you underwrite?
I think we will have co-investment. And I think we work with bank. I think we want a client to benefit from the investment. We're not a bank. We don't have a broker-dealer. We don't try to sell to other people and making a fee. And I think that's been a good model for us. And I think, you know, if you look at the net result of Meta and the Oracle deal, it's been incredibly profitable for investors. And I think that's, you know, that's the alpha and the omega, if I may say.
The alpha and the omega in this environment, whether it's the geopolitical issues, the economic concerns, or even just the market volatility that we've seen here, has that created new opportunities for you in any meaningful way?
Sure. You know, the stress in private credit and in, you know, BDC, you know, we were reported to lend money to one of our friendly competitor, 2-year piece of paper. It was slightly cheap. You know, these things arise because people need help. And, you know, we're going to be very opportunistic and try to maximize return. And, you know, I often say you never know what the game is going to be. Sometimes the game is great, in which case there's plenty of things to do. And like in period like 2005 and 2006, everything to us looks super expensive. And so we stay on the sideline and we wait for better time to come.
You know, I just want to point out, you know, speaking of game, did you know that Manny was taking time off from the Arsenal Madrid game?
I know. I know.
Match today.
I know.
Arsenal's up 1-0 about less than 15 minutes
ago.
You
know,
we appreciate you being here.
No, thank you. When you're an Arsenal supporter, it's a long life of suffering.
Well, we appreciate, you know, you taking a pause on that life. And I do want to get back to private credit, but before we move on totally from AI data center financing, we talk to a lot of people who also see this as a big opportunity that they're pursuing. But I'm curious, in your perspective, what are the risks here? What are you keeping an eye on as, you know, you look to maybe build this pipeline?
So our pipeline is essentially lending money to really safe company. You think of Meta, for example. Meta has $1 trillion of market cap. So when you plug this into a capital structure model, it's incredibly safe. Now, for some of the people, they're going to want to build data center in the US, and the data center, you're going to need to think about how fast the obsolescence go, and then what you do with the data center at the end, and how you're going to sell it. And this is a different sort of risk. We build data center in Europe, so far so good, but I think there's issues, and I think we'll know more 5 years, 7 years, 10 years from now. There are more complicated transactions which have to do with financing chips, GPU. They have a higher return. I think you need to structure them well. Some of them will be public, some of them will be private. And we look at the attractiveness of any possible deal and see how they work out. And I'm sure there'll be here and there deals which don't work out so well. Either people cut corners, or it's less attractive, or people are desperate for.
Well, to your point, it's going to be fascinating to see what the story looks like in 5 to 7 years. But let's
I don't know about you. I don't remember what it was like when steam came in England in 1770.
No, I'd really have to search back in my memories. But
we were talking about Mesopotamia earlier. Now we're talking about steam in England. So a lot of historical parallels.
Yeah, Mesopotamia is more exciting than steam, but I would agree with that.
Let's talk about the exciting world of private credit a little bit more here, because coming out of the quarter that we saw with all the redemption requests, the question has been raised whether or not this push to put private credit, private assets in general, into 401ks, into retirement systems, whether or not that's an appropriate place for them to live. And I wonder how you're thinking through that at PIMCO.
Well, I think there are various layers of the question. I think the first question is the investor tolerance for illiquidity. And I think one needs to carefully think about that. I think the second question is, where do you mark your position? And what's the fair market price in terms of discovery? And I think it's fair to say that in the private equity world, most positions were marked to model. In our world, everything is daily mark. And I think that the moment you attack the retail market, every single investor is going to buy and sell every single day. And so the valuation is really, really important. And I think people sometimes get confused between valuation and then redemption, and then illiquidity, and they're connected but different issue. And at the end of the day, people are going to look at semi-liquid and sort of say, is that better on a risk-adjusted return than other options I may have in terms of investing? And then everyone is going to make different decisions. I think what may not be understood when you talk about the 401k market is that the 401k market is very good for people who retire. It's very cheap. The options make sense from a very long-term standpoint, and you can buy index fund and low-fee fund for a very long time at cheap valuation, and I think that's probably a good thing.
I am curious about what's been going on with interest rates, and particularly, given the outsized roles PIMCO has in the MBS market, there's been a lot of talk about whatever's going to happen with Fannie Freddie and whether them being in limbo actually benefits PIMCO to a certain extent here. Is that something that you're talking about?
Of course.
Okay. All right.
And my partner Dan Iverson comes from the mortgage world. This is our bread and butter. Mortgages have rallied quite a bit. It's an integral part of what we do, and we're going to see what Kevin Walsh decides to do with the balance sheet of the Fed. There may be more mortgages. Mortgages are really important because that's how we all buy houses. And of course, if there was a way to get mortgage rate lower, everything else being equal, it would help the economy. And of course, it's incredibly complicated in itself.
Well, you mentioned Dan Iverson. I think he was on Bloomberg a couple months ago, and he kind of talked about this idea of MBS spread compression, the idea that rates would come down. And that seemed to be tethered to also the idea of whatever changes might be afoot at the Fed with Kevin Walsh potentially coming in. Is that something that you yourself have advocated for with the administration at all?
No, we don't advocate.
Okay.
We don't advocate as a matter of,
fair enough.
I would say nearly religion.
Okay.
But
you're wishing for that?
No, all we're saying is mortgages are cheap. One way you can think about what the Fed can do is its balance sheet and what the Fed can do with its balance sheet. And, I think given the current environment and what's happening in the Gulf, it's unlikely that the Fed can cut rates. Why is that? Because if you were to cut rates right now, the back end of the curve would probably, go up, and that wouldn't be helpful because mortgage rates are linked to the back end of the curve, not the front end. And so the degree of freedom you have are not that many until the situation stabilizes and people can look through inflation and sort of say, you know what, on a secular trend, inflation is going to go down. And what to kind of come back to what we were talking of before, AI is incredibly deflationary. I mean, I don't know whether you have used Claude in your own personal life, but I mean, it's unbelievable. It's unbelievable, and I think we are big users of AI, and I think it's a big capex investment for us in terms of making sure that.
Well, talk to us about that a little bit more, in the short amount of time we have left with you, because that's a big question across industries right now. How are firms actually implementing AI? You said it's a big CapEx spending. Have you seen a return on that? And if so, where?
Well, I'll give you a very simple example. There's been a situation with a fraud called Tricolore, okay? And Tricolore is a situation where you have many different parts of an origination platform, and there's many documents to check and so on. What's better than AI? To check at every single agreement and making sure that you have another pair of eyes who systematically look at these things, and you need to basically have the right system to do so, but it's going to give us another way to look at, for example, related party transaction and the cash and who has access to the cash, and just making sure there's another pair of eyes. And that's a good example of what AI can do, and it's incredibly powerful, and if you train it properly, you're going to get to really, really good results. And I think we have a whole database of experience that we're going to train our own model on, use an LLM from the outside, and sort of make sure that we have better predictive analytics in terms of what we do.
All right. Well,
have you always been an Arsenal fan?
Since 1992.
Okay.
1992.
My condolences.
All right.
I know. We won in 2006. We were undefeated.
Okay. All right.
Well, it looks like you're going to win at least this game. I hope I didn't just jinx it.
Don't jinx it.
Manny Roman, really great to spend some time with you.
Nice to see you again.
That is Manny Roman. He is the CEO of PIMCO. Now, coming up on The Close, we're going to be speaking with the CEO of onsemi about the chipmaker's latest earnings report, plus the latest with Wall Street titan Ken Kencel on the state of credit. This is The Close on Bloomberg. onsemi reporting first quarter results yesterday that were better than expected, with an outlook that was largely in line with expectations. Now the results signaling a firm path to recovery for the chip maker. Let's discuss with Hassane El-Khoury. He is the CEO of onsemi, joining us now for more. Hassane, great to see you.
Good to see you.
So let's talk a little bit about these results, because taking a look at what the sell side has to say, it seems like there's an idea out there that the recovery in your key markets will maybe be a little bit slower than hoped. So just walk us through what you're seeing there.
So I'll talk a little bit about the markets in general and our key markets. And I'll start with the highest results, which is the positive surprise, which is the AI data center. Of course, we entered the quarter 90 days ago expecting growth in AI data center. We talked about the high teens growth. It came in at 30%, so almost 2x, and also doubled year over year, with the guidance that I gave for 2026 that we're going to double that revenue from 2025. Then we moved to industrial. You know, the general parts of industrial have had better than we expected also, so that signals a broader recovery. And of course, we can correlate to the PMI being better than what it was 90 days ago, with the energy side of the industrial more on the second half of the year. Automotive is where everybody was expecting, and not I wouldn't say a recovery, but was expecting potentially a new update on it. And my update was it's still the same. We are shipping to end demand, but that end demand has not really recovered yet. That now, whether you believe that's going to be the second half of the year or not, at least the first part of any recovery is balance, and we are at that balance.
So we've reached the trough, you think?
We've reached the trough. I actually called the trough, the bottom, which I have not done up until this quarter.
Okay, all right.
Which means that from now we are expecting a growth trajectory, and I said, you know, the second half will be a growth from the first half of this year. So that signals a better than expected overall.
I mean, looking forward, I am curious about your strategy with China, this idea of innovating in China, powering the world, or whatever the phrase was that you used. I mean, you're doing that at a time where there's a lot of scrutiny right now on U.S. companies doing business with China in any way that Washington maybe finds unsettling. How do you navigate that?
So the navigation is it benefits us also as a U.S. company, where the pace of innovation, but also how much you push the boundary of innovation, we carry that forward here. I'll give you an example. We are leaders in 800-volt power management in cars and EVs. We're number one in that market. We have broken through a lot of that technology barriers to get to that 800-volt. Where's AI data center headed? To 800-volt, high voltage DC. That capability, which we've been doing for the last 5 years in automotive, we are able to carry and intercept with a very quick introduction to remove the barrier of power that we see in AI data center. We're able to leverage that very quickly and introduce it. And the fact we still manufacture in North America, it's a win-win for us as a North American semiconductor supplier.
Yeah, and just real quickly, I mean, so you are consolidating your fabs, right, into some the higher. Is that the idea?
Correct. Yeah. So we call it the Fab Right, which is consolidating our fabs. We actually shut down fabs overseas, and we brought that capacity back to the U.S.
To the U.S., right, which is what this administration wants to see.
That's exactly it.
And you're going to continue to do that.
We're going to continue to do that.
All right, Hassane, great to have you here. And congratulations on your most recent earnings. Hassane El-Khoury there, the CEO of On Semiconductor. Of course, they had their earnings yesterday. We got earnings today out of AMD. Supermicro, also a big in the data center business as well. You could take a look at the after-hours trade there. AMD shares were actually up about 6%. So the knee-jerk reaction was a little bit tepid, but you see investors now finding a little bit more reason to be optimistic about what they heard. And why wouldn't you? I mean, they did provide a wide guidance, and maybe that's scared a few folks here. But you're still talking about a business, at least on the revenue side, growing at about 38%.
I will say they had a high bar, at least when you take a look at the market performance as of late. You think about April, it was huge for a lot of the chip names, particularly for AMD shares rising 74% last month alone. So expectations maybe at least elevated from the market's perspective, but you can see that rally has been building after hours. It's going to be interesting to see if it holds through tomorrow's open.
All right, let's get back to what's been going on in the credit markets. Our next guest has been through multiple credit cycles, starting his career over at Drexel Burnham, then helping build high-yield businesses at Chase, at SBC, Warburg, then founding Churchill Financial, then going to Carlyle, then rebuilding Churchill under Nuveen's umbrella. And guess what? He was named just last year the M&A Advisor into the M&A Advisor Hall of Fame last year in 2025. Ken Kencel joins us here. Great to have you here.
You're always in our Hall of Fame. Good to see you. Hall of Fame. That's
Hall of Fame. Are you tired about talking about the next shoe to drop in private credit?
All I get asked these days is, tell me about private credit. What are we seeing? What are the opportunities? What's going on? The short answer is, I don't think we've ever seen such a dichotomy that we're seeing now. The fundamentals remaining very strong. And yet the narrative and the dynamics, in the media have been more critical. So, look, I'm here to tell you that if you look at underlying what's going on with portfolios, qualities remain very good. We're not seeing any evidence of increases in default rates or otherwise credit deterioration. So, I think I think we're in a bit of a contrast period of time. Obviously, we're looking at the data real time, but we're certainly not seeing anything right now that would indicate any real problems.
I mean, you've really sort of made your bones in the middle market direct lending. I am curious just about the evolution of that market. Is it still middle market? I mean, because some of your competitors are kind of going up to upper middle market, if you will, which I don't know exactly what that means. What is the middle market these days? And is it healthy?
Yeah, I think it is, and I think it's actually coming back to us, right? I mean, you certainly saw firms kind of move up and almost compete with the syndicated loan market. That's coming back our way now. I think, given the dynamics and the redemption pressure you're seeing in some of those managers, those companies are now coming back and looking at, the core middle market as a place to finance, right? So I think we'll see slightly larger deals, potentially a little bit better pricing. Underlying terms and conditions maybe favoring lenders a little bit more than they had been. So a little bit of disruption is not a bad thing.
Ken, if you'll forgive me, I do want to go back to just private credit broadly right now, because I am curious. I hear what you're saying. The fundamentals are good. There were some maybe liquidity expectation mismatches, but how are you thinking about private credit returns this year? Have they eroded at all versus last year?
The short answer is, we're continuing to see good quality. I mean, it's all about quality at the end of the day, right? And I would say the quality we're seeing now in terms of deal activity remains quite good. We actually had a record quarter in the fourth quarter. First quarter has been good. It's slow. Things slowed a bit in March and April, so we definitely did see a bit of a drop off. But I think what you're seeing now with the disruption is the opportunity to get a little bit better pricing right? So I'd say 25, 50 basis points better pricing than we've seen. I think you've seen an opportunity where the dynamics are a little bit better in favor of lenders. So I think the risk-return dynamic right now is actually, moving more toward lenders and an opportunity to put out capital at somewhat better returns. Things were getting a bit overheated, particularly in the large cap market. So having it come back a bit, the redemption pressure that some of those lenders that relied heavily on retail are now pulling back a bit. So it actually is helping the supply-demand dynamic a little bit.
Well, that's what I've been wondering, whether or not it's getting maybe a little bit less crowded. Citigroup, someone over there used the phrase of tourists coming through on the lending side. And I wonder, are you seeing the tourists back out a little bit?
I think there's something to that. I think, and not only are they pulling back a little bit due to some of the redemption dynamics that are playing out, but I also think you're starting to see the lenders that maybe were a bit aggressive over the last several years starting to see some issues in the portfolio. I don't think it's broad-based, but I do think you're starting to see distinctions between managers, which is a good thing for the larger, higher-performing managers like ourselves, and maybe some of the tourists not really being able to raise capital or maybe having some issues. So I think it's overall, I'm quite optimistic about what we're seeing right now.
You think we're going to see more real alpha out there?
I think we are.
Yeah. Okay.
I think we're seeing more differentiation among managers. The thing I would say is that institutions have not stopped allocating at all to private credit, right? Despite all the noise on the retail side and some of the redemptions we've seen, I think those will continue for the next few quarters.
Yeah.
On the institutional side, it's been almost the opposite. Right? Institutions saying, no, we like private credit. We like the long-term returns. We understand there's a fundamental illiquidity, but we're getting paid a premium for that illiquidity. So I don't think I've seen the kind of dichotomy we're seeing right now and that we've seen in a while. So.
Ken, great to have you. As always, Ken Kencel is the CEO and president over at Churchill Asset Management as we wrap up our coverage for this Tuesday. But guess what? We're going to be back tomorrow, Katie.
Day 3.
Yeah, and we got a lot of big guests here. We're going to talk to Tony Manella over at Eldridge and who else here?
We're also going to be speaking to the CEO of Match Group as well as the CEO of Elevest.
Yeah.
And we're going to have a baseball conversation as well. You're going to have to help me out there.
It's Mark Atanasio. I mean, Milwaukee Brewers. What do you come on.
I just learned what
baseball.
Arsenal is.
A lot that Dina De Lorenzo over at Guggenheim, a full lineup. We appreciate you joining us here from the Milken Conference with our special extended coverage of the close on Bloomberg.